Hey, my dear students, a very good morning to each and everyone. I hope you guys are all perfectly fine. I hope you guys are all perfectly good. And I do wish and hope that you guys are preparing for your upcoming September 25 examination in a very great manner. So, as promised, we are now going live with this marathon for CA final audit for September 2025 attempt. So, you guys have been asking me for this for a very long period of time. So without any delay further, finally the time has come now. So let us hit this marathon series. It is going to run over a span of some 4 to 5 days. I hope you all guys are going to love and enjoy it. So those people who have joined live, so just let me know that am I audible? Is the stream and all perfectly fine? So I'm looking at your messages now in the chat box. So please let me know, is everything okay from my side? Yeah. Fine. Good morning, everyone. Good morning. Yep. Perfect. Thank you so much, guys. Thanks for your replies. Right. So without any delay further, let us hit the agenda. Why we are doing this live and all. So we will directly try to hit our agenda now. So as I have told here, we are going to do a marathon, live marathon we are going to do. And so let me give you a few points before I actually come to the concepts and all. See, throughout this marathon, I'm going to make use of various resources. So I'm going to make use of various resources. Like as you could see here, we have one comprehensive concept notes here. Mainly throughout this marathon, I'm going to take the help of this concept notes. Whatever I'm showing you here, whatever you are able to see it on the screen. So this, I'm going to use it throughout this marathon. I'm going to use it, and various other resources I'm going to use, like I'm going to make use of this question bank. At various instances there are very interesting and tricky questions in various chapters, that questions also will be referring to once. So that question bank I will be using. So I will be using the concept notes, I will be using the question bank, I will be taking the help of some summaries and charts. So like that, multiple resources we are going to make use of it throughout the marathon. Sir, now where we can get these resources, where you can get all these resources? Very simple, guys. In the description of the video you will find a link to the website. Just you have to visit that website, and in that website go to the free resources section. So there I have created two folders. Let me show that to you. Yeah, this is what the website is. So just you have to visit the website www.fingatesacademy.com. So just visit the website, come here and tap here on the free resources section. So you will be able to find the resources for CA final and CA inter as well. So for CA final, come to the course CA final, and in the CA final you will be able to find two subfolders. In one folder it will contain the main material, and in another folder it will contain the charts and summaries. Like if you come to this first folder here, you will find concept notes, question bank, and also targeted chapter preparation strategy. Recently I have done the video, so all that you will be able to find it here. Similarly, if you come to this summaries and all, here we have for our EOB batches. Recently we had the EOB batch, and a few months ago we had the regular batch. For that EOB batch, for that regular batch, as a part of our classroom discussion, we took the help of various summaries, charts we have drafted. So all that summaries and all also you'll be able to find it here, right? So like this, every resource, whatever resource I'm going to make use of throughout this marathon, all these resources will be made available in the website. Not just that, for the purpose of this marathon, whatever notes I'm going to make here, all that notes also will be updated at the respective folder of the free resources section. So every resource you will be able to find it. No need to worry about it at all. Clear, everyone? Right. So having told about resources, so as you could see here, CA final concept notes we have, it is completely colored notes. Not just that, guys, even if you want to order this colored notes, that also you can do it. So just come to the courses, just go and select the books section. So there you will be able to find the books. So you can purchase concept notes. If you want only concept notes, you can purchase only concept notes. If you want question bank, you can purchase only question bank. If you want both concept notes and question bank, so whatever you want, even you can order it. So I know since it is a high time, the exams are around the corner, so we will make every effort to make sure that the book will be delivered as early as possible. Depending on your location, we might make it delivered within a span of some 4 to 6 days. We will deliver it to you, so you need not worry about it. Books will be delivered, right? Fine. So without any delay further, let me directly jump into the concept, right? Perfect. Okay guys, so let us have one basic structure, what and all we are going to cover, what and all we are supposed to cover as a part of this marathon. Let us try to have a overall structure once. So first of all, what is the title of our subject, everyone? So what is the title of our subject? So title of our subject says here, Advanced Auditing, Assurance and Professional Ethics. So this subject, from the title of the subject itself, it is very clear that we are required to cover three aspects. I can divide the entire CA final advanced auditing syllabus into three parts. So one part is talking about advanced auditing. So mainly one major aspect which we are going to discuss at the CA final is relating to audit. Then we have a part of the discussion which is talking about assurance engagements. So we have some part which is discussing about assurance part. Then we have something related to professional ethics part. So three aspects are there, three perspectives are there for the CA final audit. So we have advanced auditing, then we have assurance related activities, then we have professional ethics. So like that we have three parts at the CA final level. And the major discussion, I will say some 50 to 60% of the discussion whatever we are going to have here, that will be concerned about auditing only. So mainly we are going to talk about audit. And see, also they did not just mention the term auditing. What they have mentioned is advanced auditing. So that means at the CA final level, you are supposed to learn the advanced concepts of the auditing. Sir, if we are supposed to learn the advanced concepts of the auditing, what about the basics, sir? Basics are something which you should have learned it at the CA inter level, but I know it's been a very long time since you have appeared for the CA inter examination. You might have lost touch with the concepts of the CA inter basics. That also we will bring it here. So touching upon the basics, we are going to tackle the advanced concepts of audit. Okay, so that is a significant part of the discussion which we are going to have. Then we have something called assurance. We will talk about what do you mean by assurance engagements. Assurance is a kind of engagement which we chartered accountants in practice will do in order to make a living in the society. There are various kinds of assurance engagements. Audit is also a kind of assurance engagement. Then we have something called review engagement. Then we have something called related services. And also we have something called assurance engagement or prospective financial information engagements, non-financial information engagements. So like that, we are going to have, apart from audit, various other assurance engagements. On that, we are going to speak about it. Then we have something called professional ethics, which is talking about being a professional, being a person who is accountable to the society, being a person you are doing some professional work. Depending on your work, many people are taking their decisions, not just their normal decisions. They are taking their economical and financial decisions on the basis of the work which you have done. So it is expected from you, it is bare minimum expected from you to follow some ethical values, moral values. You are supposed to be a person of integrity. So like that, there are some moral values and ethical values which we are required to follow, that we are going to discuss in the professional ethics part. Small part, important from the examination perspective, easy for the preparation, easy for remembrance, easy for even writing in the examination. So basically we will cover here Chartered Accountants Act. We have a Chartered Accountants Act governing we chartered accountants after our qualification. Even as a student also, Chartered Accountants Act will become applicable for us. But once we qualify our examination, so we will be called as either member in practice, member in service, but you are expected to follow some ethical values and the moral values when we are carrying out our profession in the real world. So that guidance is covered under Chartered Accountants Act, and also Chartered Accountant regulations are there, CA regulations are there. So that we are going to discuss in the professional ethics chapter, right? So first we will be hitting the area of advanced auditing. So advanced auditing we will try to hit upon. So mainly we will start with that discussion. Fine, right? See, before we can start about advanced auditing discussion, as I have told, at the CFNL level, we are required to learn the advanced concepts. But you all might be aware, we can become master in anything only when we have strong knowledge in the basics. Agree or not? Definitely, right? So if you want to become an advanced level professional, or if you want to master any subject area, you can become such a person only when you are strong with the basics. So here at the CFNL level, we are going to discuss various advanced auditing concepts. But in order to have all that advanced concepts settle at their proper places, we need to revisit our basics once again. we need to revisit our basics once again. So what we will try to do is quickly we will try to go back to our basics, we'll spend very less amount of time on this basics. So we'll try to have a basic intro for the subject of audit, and once we have that basic intro, then the going forward discussion will remain very smooth here. Okay, right. So having said that, first I will start my revision, I will start my marathon with this introduction to the audit. Sir, what exactly is the meaning of the audit? So we are not going to spend much of a time. So just I'm having this discussion to ensure a smooth flow in our subsequent concepts. So in order to have smooth flow of discussion in the subsequent concepts, it is very much necessary for us to have a stronger understanding of the basics. Clear, everyone? Right. So let us have a look at the introduction to the audit. Sir, what exactly is the meaning of audit? You are saying we are going to mainly discuss about advanced auditing, but first of all, what is the meaning of audit? It becomes necessary for us to understand the meaning of the audit. The term audit has been defined something like this. So they say that audit is a kind of service which we chartered accountants offer to the society. Like we are all putting all this effort, we are going through all this hard work, we are preparing for the examination, we are qualifying the examination to get that CA degree, right? So once you qualify your CA final examination, why are you putting all this effort? Definitely we are putting all this effort to make a living in the society. Yes or no? So how we can make a living of the society? By providing various services, like we provide tax consultancy services, income tax services, accounting services. So like that various services we provide, a bunch of portfolio of services is there which we chartered accountants will render. Out of that, one service which we render to the society is audit. Like various other services, audit is also one of the most important service which we chartered accountants render to the society. So what exactly we will do here, sir? When I say I'm providing audit services, what exactly I'm trying to do here? So if you look at the definitions here, so they have defined something like this. An audit is an independent examination. What is an audit, guys? So they are saying audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. How they have defined the term audit? So they have defined the term audit in such a manner that audit is when I say I'm doing audit, what exactly I'm trying to do there is I'm trying to independently examine in an independent manner. I'm going to do the examination of what? Financial information of an entity, whether that entity is profit oriented or not doesn't matter, what is the size of the entity doesn't matter, what is the legal form of the entity doesn't matter, and why I'm doing this audit is the ultimate objective is to express an opinion on the financial statements. So what do you mean by this? First of all, they say that first we have to address, sir, what exactly happens in the audit. So they say that in audit, what exactly is going to happen is independent examination is going to happen. So what exactly happens in the audit? When I say I'm doing audit, I'm doing examination. Sir, what is the meaning of the term examination? Examination means verification. What is the meaning of the term examination? Examination means verification or checking, you can call it, or even scrutinizing, you can call it. So basically, when I say I'm doing audit, I'm doing verification, I'm doing checking, I'm doing scrutinizing. And that examination is not an ordinary examination. That examination is going to be an independent examination. So you are verifying, and how you are going to do that verification process is in an independent manner. So in an unbiased manner, in an uninfluenced manner. So independence is one of the quality of a chartered accountants which we all must possess. That means whatever decisions we are forming, that decision should be completely based on our judgment. It should not be influenced. It should not be changed according to other person's wishes and directions. That quality of the person, we call it as independent, free from bias. So when I say audit, I'm doing verification or checking, and that examination, that verification or that checking is not an ordinary checking or verification. It is an independent examination. Sir, what exactly you are checking here? Okay, sir, understood. You are telling audit is an independent examination, but what exactly I'm going to examine, but what exactly I'm going to verify? So the definition says we are going to verify the financial information. Sir, what do you mean by financial information? All the financial related data of your client. So basically, if I have to put it in simple terms, the financial statements along with the books of accounts, this put together, we call it as financial information. So as we all are aware, every entity will prepare the financial statements, but that financial statements will be prepared on the basis of source data. The source data for the preparation of financial statements is books of accounts. So you take the financial statements, add that source data books of accounts, that collectively I call it as financial information. Right. So as an auditor, I'm going to verify the financial information. Now, whether profit oriented or not. See, the entity whose financial information you are verifying, whether that entity is a profit oriented or it is a non-profit oriented, that doesn't matter. The entity whose financial information you are verifying, that could be a profit oriented entity, that could be a non-profit oriented entity. That is not going to change altogether what I'm doing in the audit. It will remain the same. So it doesn't matter whether my entity whose financial information I am verifying, is it a profit making entity or is it a non-profit making entity? That is not going to matter at all. Then, irrespective of its size or legal form, the size of my client also doesn't matter. Is the entity is a very big company or entity is a small entity, all that doesn't matter. Size of the entity doesn't have any impact on the audit. Similarly, legal form. What is the legal form of my client? Is my client is an individual, sole proprietor, or is it a partnership firm, or is it a LLP, or is it a company? Even this also does not change the scope of my audit altogether. Here and there, reporting requirements will change, but overall objective of the scope is going to remain the same. So audit is an independent examination of the financial information of an entity, whether profit oriented or not, irrespective of its size or legal form. Sir, if we are doing that independent examination, if we are doing that verification, if we are doing that inspection, if we are doing that checking, that too in an independent manner, there should be one ultimate outcome of it. No, every activity should contain one ultimate outcome. Sir, what is the ultimate outcome of the entire process of the audit? There should be one final product, right? So if I am teaching you these classes, if I am providing you the services, what is the final product? You getting qualified in the examination, right? Similarly, when I am providing, if I am a chartered accountant, if I am providing audit services, if I am doing independent examination of the financial information, sir, what is the final product of it? What is the ultimate outcome of it? The ultimate outcome of it is to express an opinion. So what they're trying to say here, what is my ultimate objective of doing all this? The ultimate objective of doing that independent examination is you have to express an opinion. You have to tell your opinion. Sir, on what I have to say my opinion? Whatever you have examined, whatever you have verified. So what I am verifying, so you are independently verifying financial information. On that financial information only, you are required to express your opinion. So that opinion which you are expressing, that is going to be the final product of the entire process of the audit. And this opinion is very, very important. Why? Because this opinion is the heart of the audit. This opinion is the heart of the audit. So like any opinion in this world, you take any opinion in this world, there will be only two broad categories of the opinion. One is a good opinion, other one is a bad opinion. Or even you can call it either it is a positive opinion or it is going to be a negative opinion. Even audit is not an exception. In audit also, once the auditor has completed his independent financial verification, then he will express his opinion. Here also, either he can give a favorable opinion or he can give a unfavorable opinion, or even you can call it as good opinion or bad opinion, or you can say positive opinion or negative opinion. But this is all a layman terminology. If I give technical names for these opinions to the audit, in the case of audit, I can broadly divide the opinion of the auditor on the financial information into two categories. Number one is unmodified opinion. Number one is unmodified opinion, and number two is modified opinion. So number two is modified opinion. So we are going to talk more about this modified and unmodified opinion in our subsequent chapter. Immediately once we are done with the intro, we will be taking up the audit reporting chapter. There we will talk more about it. So broadly, the opinions can be divided into two categories: unmodified opinion and modified opinion. So nothing but this unmodified opinion, if I have to put it in very simple language, this I will call it as a positive opinion. Unmodified opinion, if I have to put it in simple terms, that I call it as negative opinion. But being a professional, we should not be using that positive, negative layman terms. We should not be using it. We should be using the technical terminology, which is unmodified opinion or a modified opinion. Clear? Right. So that is the ultimate objective. And few more things here. So as an auditor, just now as I've told, the ultimate objective of the auditor is to express an opinion. And that opinion, if I talk in specific terms, that opinion is required to be expressed regarding two things. Number one, whether financial statements are free from material misstatements, and whether financial statements are prepared as per applicable financial reporting framework. So that's what you will be able to see here. So the main objective is to express an opinion, and that opinion is required to be expressed on two aspects. Number one, whether financial statements are free from material misstatements, and also whether financial statements are prepared as per applicable financial reporting framework. Guys, it becomes very necessary for us to understand the meaning of the terminology here. What do you mean by misstatement? What do you mean by applicable financial reporting framework? This is very important for us to have a smoother discussion going forward. So let us take some little amount of time to make us clear about this concept of applicable financial reporting framework and what is the meaning of the misstatement. Why? Because throughout the rest of the discussion, at various places, you will be able to find this terminology, and I don't want you to keep the blank faces when you come across these terms. So here itself, we will take some time, become familiar with the terminology, so that going forward, if at all you come across this terminology, you're not keeping the blank faces. Immediately things will start flowing to your mind. Right. So let us try to understand first with what is the meaning of applicable financial reporting framework. So first of all, sir, what is the meaning or financial reporting framework? We will try to understand. See, what is the meaning of the term framework? The meaning of the term framework is it is a set of rules and regulations. A set of rules and regulations which are required to be followed, that we call it as framework. Whereas, what do you mean by financial reporting? Financial reporting means it is a process of preparation and presentation of the financial statements. So at your CFNL level, you have something called financial reporting, right? The subject called financial reporting. So what exactly you are going to learn in that financial reporting subject? You are actually learning how to prepare the financial statements. What is the process of how to prepare financial statements, how to present the financial statements? That's what you are going to learn here. Simply accounting, advanced name for accounting. So financial reporting is the process for preparation and presentation of financial statements, and framework means rules and regulations. Sir, what do you mean by financial reporting framework? So if you combine these two, the set of rules and regulations which are required to be followed in the process of preparation and the presentation of the financial statements, that only I call it as financial reporting framework. So what do you mean by financial reporting framework? The set of rules and regulations which I am supposed to follow in the process of preparation and the presentation of financial statements, that I call it as financial reporting framework. Like for example, if I have to follow Schedule 3 and accounting standards while preparing financial statements, Schedule 3 and accounting standards will become financial reporting framework. So if I have to follow Banking Regulation Act, that becomes an financial reporting framework. So whatever rules and regulations you are following in the process of preparation and the presentation of the financial statements, that I will call it as financial reporting framework. But they use the phrase here, applicable financial reporting framework. What is the phrase they are using? Applicable financial reporting framework. So in order to understand applicable financial reporting framework, I would like to ask you one simple question. Guys, you tell me, it is whose responsibility to prepare the financial statements? Preparation of financial statements is whose responsibility? Say for example, there is a company X Limited. You are a auditor, Mr. A, you are an auditor. You have been appointed to conduct audit of this client X Limited. Now, as a part of this audit, so as we have all seen, as an auditor, you are required to do the independent examination of financial information, which contains financial statements along with the books of accounts. You tell me, it is whose responsibility to prepare and present the financial statements and books of accounts? So as we all are aware, the primary responsibility, not the primary responsibility, the responsibility, overall responsibility for the preparation of the financial statements and the presentation of the financial statements is always and always resting with the management of the organization. Though in reality, we chartered accountants are doing it, but as per the norms, it is whose responsibility to prepare the financial statements. It is always and always the responsibility of the management. So preparation of financial statements, that responsibility is always with the management. Now, the management of every organization, while preparing their financial statements, pay attention to the terminology here. So the management of every company, while preparing the financial statements of their respective entity, so depending on nature of financial statements and also depending on purpose, depending on nature and depending on the purpose of the financial statements, the management of the organization itself will adopt what set of rules and regulations they have to follow, that rules and regulations which have been adopted by the management. So very careful, you have to be very careful here. So who will adopt the financial reporting framework? Management. Depending on what nature of the financial statements and nature of the entity and the purpose of the financial statements, the management of the respective organization will adopt, they will decide, okay, our entity is this, our purpose of the financial statements is this, so that's why we will follow this set of rules and regulations, that they will select and adopt it. Who will select and adopt it? Management. That selected and adopted framework, I call it as applicable financial reporting framework. That selected and adopted framework, I call it as what? Applicable financial reporting framework. Like for example, the management of Reliance Industries Limited, while preparing the financial statements of the company, they decided that, okay, nature of Reliance is a company and the purpose of the financial statements is for everybody. So what they have thought is, let us do one thing, let us follow Schedule 3 and accounting standards. Who selected? Management itself has selected. So the management, depending on the nature of the entity and the purpose of the financial statements, they have chosen, they have adopted Schedule 3 and accounting standards they will follow in the preparation of the financial statements. Now this becomes applicable financial reporting framework. Similarly, bank, say for example, S Bank is there, the management of the S Bank is required to prepare financial statements. The management, keeping in mind the nature of the entity, keeping in mind the purpose of the financial statements, they have decided that they will follow the Banking Regulation Act in the preparation of the financial statements. Who has adopted it? Management has adopted it. Depending on what they have adopted, depending on the nature of the entity and purpose of the financial statements, they have adopted it. So this Banking Regulation Act will become applicable financial reporting framework for S Bank. So like that, depending on the nature of the entity, depending on the purpose of the financial statements, who will adopt? The management will adopt a set of rules and regulations which they will follow in the preparation of the financial statements. So that adopted framework, I am going to call it as applicable financial reporting framework. Okay, so here one important point you have to observe: as an auditor, your responsibility is not to adopt the applicable financial reporting framework. Adoption of the applicable financial reporting framework is the responsibility of the management. Then what is auditor's responsibility is checking whether really financial statements are prepared as per applicable financial reporting framework. Like if I am getting appointed as auditor of Reliance, my responsibility is to check whether really the financial statements of Reliance have been prepared as per Schedule 3 and accounting standards. If I am conducting audit of S Bank, my responsibility is to check whether really the financial statements of the S Bank are prepared as per the Banking Regulation Act. Clear everyone? So that is what my responsibility, whether financial statements are prepared as per applicable financial reporting framework. Now comes the most important discussion, most important discussion we are going to have. There are chapters built on the discussion which I am going to explain. There are various chapters which have been built on the basis of the discussion we are going to have now. Okay, so the most important discussion we are going to have now is there are various types of frameworks. So what are we going to discuss? There are various types of frameworks, there are various types of financial reporting frameworks that we are going to discuss now. Sir, what are the various types of framework? Now, on the basis of purpose, frameworks can be broadly divided into two categories. So if you come to the material here, so on the basis of the purpose, we can broadly divide the frameworks into two categories. First of all, we can broadly divide the financial statements into two categories on the basis of purpose. Number one is general purpose financial statements and number two is special purpose financial statements. Sir, what is general purpose financial statements? They simply say that general purpose financial statements are those which are prepared as per general purpose framework, whereas special purpose financial statements are those which are prepared as per special purpose framework. That's how they have simply defined. But that discussion will remain incomplete until and unless we understand what is the meaning of general purpose framework, what is the meaning of the special purpose framework, that we have to become very clear. So I could say here, on the basis of the purpose, frameworks are broadly divided into two categories: general purpose framework and the special purpose framework. Sir, what is general purpose framework? General purpose framework refers to such a framework which fulfills financial information needs of various users simultaneously. Guys, very important discussion. Why? Because as I have told, on the basis of this discussion, altogether some chapters are built. If you want to have thorough understanding of that chapters, you need to have a strong understanding of this basics, right? So what is a general purpose framework? They say that general purpose framework refers to such a framework which fulfills financial information needs of various users of the financial statements. So as we all are aware, management will prepare financial statements, but there will be various users of the financial statements. Sir, who could be that user? Management themselves will be one of the user. Shareholder could be user. Banker could be an user. Government could be an user. So like that, there are various users of the financial statements. If the management, while preparing the financial statements, if they have followed a set of rules and regulations, and by following that set of rules and regulations, they have prepared a financial statements, and that financial statements will fulfill simultaneously all the needs of the users. If the management follows a set of framework, a set of rules and regulations in the preparation of the financial statements, and if that financial statements are released, if that financial statements are prepared, that will fulfill information needs of various users. It will fulfill information needs of all the users. It is not specific for one user. That framework will fulfill information needs of all the users simultaneously. That kind of frameworks we are going to call them as a general purpose framework. Let me give you one example. Say Reliance Industries Limited. Now Reliance Industries Limited is having various users. Like as I have told just now, management will be a user, shareholder will be a user, bankers will be a user, government will be a user, trade receivable, trade payable. So like that, multiple users are there. Now what Reliance have done is they have prepared their financial statements. Every year, listed company will prepare financial statements and upload it on their website and even submit to stock exchanges. So what management of Reliance Industries Limited have done is they have prepared the financial statements using Schedule 3 and accounting standards. On the basis of that, they have prepared the balance sheet in which they have explained what are the state of affairs, what is their financial position. They have prepared a P&L depending on that, in which they have shown what is their profitability position. They have prepared a cash flow statement in which they have explained whether they had a net cash outflow or inflow. And also they have prepared statement of changes in equity, and they have prepared notes to accounts in which they have given all the disclosures. Okay, so now you tell me, these financial statements which are prepared by the management of the Reliance, that too prepared as per Schedule 3 and accounting standards, will that fulfill information needs of all the users? Yes. The requirements of such a framework are such that these financial statements prepared as per this framework will fulfill information needs of various users. Management can use it for decision making, shareholders can use it for their investment decisions, government can use it for the determining of tax liability, and bankers can use it for the purpose of giving of the loans, creditors can use it, everybody can use it. So here the management has prepared the financial statements as per one such rules and regulations that fulfilled information needs of various users simultaneously. So this I can call it as general purpose framework. So the best example of the general purpose framework is Schedule 3 and accounting standards. This is one of the best example for the general purpose framework because it fulfills information needs of various users. Now, why it will fulfill information needs of various users is why? Because it will have some characteristics. It will have some characteristics. General purpose framework will follow some characteristics. What are they? Sir, they follow generally accepted accounting principles like concept of prudence, concept of conservatism, matching concepts. So they follow some generally accepted accounting principles, and they follow accounting standards, and they follow fundamental accounting assumptions like going concern, accrual, consistency. They follow the fundamental accounting assumptions. And number 4, they are prepared periodically. They will be prepared what? Periodically. So they will not be prepared for random durations. There will be one periodical duration. For that periodical duration only, these financial statements will be prepared. So that's why they fulfill information needs of various users simultaneously. Okay, sir, we understood what is general purpose framework, but what is the meaning of the special purpose framework? So exactly the opposite of that general purpose framework. They say that special purpose framework refers to such a framework which fulfills financial information needs of specific users, which will fulfill financial information needs of what? One or two specific users. Such a kind of framework I'm going to call it as special purpose framework. On the basis of the special purpose frameworks, almost a separate chapter has been built. Like we have one specialized areas, we have a chapter called specialized areas. In that we are going to discuss 800 series. In that, significant discussion we are going to have regarding this special purpose framework. So, but whatever it is, so what do you mean by special purpose framework? The special purpose framework refers to such a framework which fulfills financial information needs of only specific users, not all the users. Like one common example which I almost always use everywhere, which has been given in the standards itself. So what is that common example is, say for example, there is a bank. So this bank, there is a company X Limited. This company needed loan from this bank, but banker told one thing, boss, if you expect us to give the loan, we want you to prepare the last 3 years of financial statements on cash basis. What the bank management has told, boss, if you expect us to give the loan to you, yes, we are ready to give you the loan, but we will give you the loan only when you prepare your last 3 years of financial statements on cash basis. Why? Because banker wants to know your actual repaying capability. Okay, this company has prepared the financial statements on cash basis and they have presented that financial statements to the bank. On the basis of that, bank has sanctioned the loan to the company. Now, they have prepared the financial statements on cash basis. They followed a rule and regulation which is cash basis of preparation of financial statements. But they have followed this framework only to fulfill information needs of one specific user. Who is that one specific user? Bank. Only to fulfill the information needs of the bank, they have prepared this financial statements. So here this company X Limited has followed a framework which fulfill information needs of not all the users. It will fulfill information needs of only specific users. So this is one example of the special purpose framework. Clear everyone? So sometimes the financial statements will be prepared as per general purpose framework. Then how to do the audit, that we will discuss. When financial statement, sometimes you might be as a chartered accountant called upon to conduct audit of such a financial statements which are prepared as per special purpose framework. How to do that audit also we are going to discuss. How to do that audit of conducting audit of special purpose frameworks also we are going to cover here. So this is one categorization of the framework on the basis of purpose. Now, on the basis of presentation, there is one more categorization of the frameworks. This is also going to be very, very important. Why? Because the types of frameworks which we are going to discuss now, its a reference will be there in each and every subsequent chapter. In each and every subsequent chapter, which we are going to have a discussion going forward, there will be a lot of references to the discussion which we are going to have now. Okay, right. So if you come here on the basis of presentation, on the basis of what? Presentation, the frameworks can be further divided into two more categories. What are they? Number one, compliance framework, and the other one is fair presentation framework. This we will try to understand. Okay, so this is the major thing in this chapter. So once we are done with the understanding difference between compliance framework and the fair presentation framework, we can go ahead and discuss the subsequent chapters. So this is the next big discussion in this chapter. Once we are done with that, this chapter will come to an end. Okay. So on the basis of presentation, the frameworks can be further divided into two more categories. Number one is compliance framework and number two is fair presentation framework. First, let me address what is this compliance framework. So they define here something like this. It refers to such a framework in which the financial statements are prepared as per the requirements of such framework without any deviation. Without any deviation, single deviation is also not permitted. Even small deviation is also not permitted. If you are following such a framework where you have to prepare the financial statements as per the rules of that framework, deviation or departure is not permitted. You have to strictly follow. Whether by following it you will get a true and fair view or not, it doesn't matter. If you are required to follow something very strictly as it is with zero deviation, with zero departure, you are strictly prohibited to deviate from the requirements of the framework. Such a framework I call it as compliance. The name itself says compliance. You have to comply with, you have to follow strictly, you have to follow. 0% deviation is permitted. Zero, no deviation is permitted at all. Such a framework I call it as compliance framework. Like if you see here in the previous case, the banker has asked us to prepare the financial statements on cash basis, and we have actually prepared the financial statements on the cash basis. We did not deviate. We know that by following cash basis of the financial statements, whatever balance sheet position we get, whatever profitability position we get from the statement of P&L, that is not an actual reflection. That is not a true and fair reflection of financial position. That is not a true and fair reflection of our profitability. But still, we have strictly followed it without any deviation. We know that by following this framework, we are not going to get a true and fair view, but still we have strictly followed. Why? Because banker did not permit us to deviate. So this framework is an example of compliance framework. So most of the special purpose financial statements will be compliance framework where you have to follow strictly without any deviation. And here true and fair view is not guaranteed. True and fair view is not guaranteed. By following compliance framework, true and fair view could be there, could not be there. There is no guarantee in that. Whereas, sir, what is the meaning of the fair presentation framework? Very, very important here. So here also the definition of the fair presentation framework says something like this. It refers to a framework in which the financial statements are prepared as per the requirements of such framework. Here also we will try to prepare the financial statements as per the requirements. Here also we will try to follow the requirements of the framework. But here we are given one freedom. Here we are given a permission. Here we are given some choice. So here also in the case of fair presentation framework also, we try to prepare the financial statements as per the requirements of the framework only, but here we are given permission. Here we are given some freedom to do certain things. Sir, what freedom has been given to us? Number one, we may provide additional disclosures beyond the requirements of the framework. That means we can add extra explanations in our financial statements even though not required in the framework. Or we can altogether deviate from the requirements of the framework. We can ignore whatever has been mentioned in the framework and follow something else also. So in the fair presentation framework, here also what we will do, to the extent possible, we will try to follow the requirements of framework. But here we are given a choice. Here we are given some little freedom to do two things. Either provide additional disclosures beyond the requirements of the framework, or altogether deviate from the requirements of the framework. So either we are given the freedom to provide additional disclosures, or we are given the freedom to deviate from the requirements of the framework altogether. Sir, but with what objective this freedom has been given? This freedom has been given to you to achieve fair presentation. This freedom has been given to you to achieve what? Fair presentation. Your objective here is fair presentation. The name itself says fair presentation. The main emphasis is on fair presentation, not just on compliance. So I will give you one example. This example is also once again given in the standards, which I will use it for the purpose of making you understand the difference between the compliance framework and fair presentation framework. Say for example, there is a company which has purchased a plant and machinery which is costing of 1 crore rupees of plant and machinery they have purchased. As we all are aware, if you have capitalized any asset in your books of accounts, as per the Companies Act, you are required to charge a depreciation. And as per Companies Act, only two methods of depreciation is permitted. One is either SLM method and the other one is a WDV method. We all are aware, even the rates are given in the Companies Act itself. So if you follow SLM method, the rate of depreciation is 10%. Say, for example, if you follow WDV method, the rate of depreciation is 15%. So if it is a compliance framework, strictly we are required to follow whatever is mentioned in the framework. So if the framework is a compliance framework, either we will charge in our financial statements SLM depreciation, ignore the residual value and all. Either we have to charge the depreciation as 10 lakh rupees in the statement of P&L or 15 lakh rupees in the statement of P&L. Why? Because these two are only permitted. So if it is a compliance framework, we will follow strictly whatever has been given in the framework with a zero deviation. Strictly we are going to follow. So if it is a compliance framework, but let me give you some extra information. Now let me give you some information regarding its consumption pattern. How this machinery will be consumed. See, this machinery is designed in such a way that it will exactly produce 1 lakh units. How many units? It will exactly produce 1 lakh units. And in year 1, they have already produced some 30,000 units out of it. How many units they have already produced in year 1? In year 1, using that machinery, they have already produced 30,000 units. Now you tell me, looking at the consumption pattern of this machinery, other than SLM and WDV, some other method of depreciation is sounding more appropriate, right? So what is that other method of depreciation which is sounding more appropriate? It is actually production units method. Which method? Production units. But if it is a compliance framework, you have to follow either SLM or WDV. That's all. We know by charging the depreciation on production units method. So if you calculate the depreciation as per production units method, what is the value of depreciation? So 1 crore is the total value of the machinery. Total capacity is 1 lakh units. Out of that, 30,000 units are already produced in year 1. So that means 30% is already consumed. 30 lakhs should have been my depreciation if I follow production units method. But which one is giving you more fair presentation? We know that the method of depreciation used should be matching with the consumption pattern. So between SLM, WDV and production units, which one is fair presentation? Production units method is more fair presentation. But if it is a compliance framework, we are not permitted to deviate. We are required to follow either 10 lakh rupees or 15 lakh rupees. But if the framework is a fair presentation framework, I told we are given freedom. No, two options we are given. Number one, either Either what you can say is you can provide additional disclosures. You can provide additional disclosure. Sir, how do you provide the additional disclosure? So what do you mean by providing additional disclosures is in the statement of my P&L, in the depreciation, I will show my depreciation as either 10 lakh rupees or 15 lakh rupees only. But in my notes to accounts, I will add an extra explanation. So what I will say in my notes to accounts is we have charged the depreciation on this plant and machinery on either SLM or WDV basis because it is a requirement of the Companies Act 2013. But looking at the consumption pattern, some other method of depreciation is more appropriate, which is production units method. If we have followed that depreciation method, our depreciation would have been 30 lakh rupees, our profit would have been this much. This is a disclosure I am providing. This is not required as per the framework, but I am doing it. I am giving extra disclosure beyond the requirements of the framework. You tell me what is the objective behind giving this extra disclosure? What is the requirement of you to go beyond the requirements of the framework and give this extra disclosure? Because you have an intention that if a user comes and reads this disclosure, he will have a better understanding. So this is one example where you are giving a permission to provide additional disclosures. And one more option has also been given to you. Either you can deviate from the requirements. Altogether, what you can do? Altogether, you can deviate from the requirements. Sir, what do you mean by deviating from the requirements? That means in my statement of P&L itself, directly what I will do is instead of charging the depreciation as per 10 lakh rupees or 15 lakh rupees, directly I will charge the depreciation as 30 lakh rupees. So here what I have done, whatever has been told in the framework, I have ignored completely that I have followed something else. Ignoring the thing which is given in the framework, I followed something else that I call it as deviate. But here also, what is my objective behind deviating? To achieve a fair presentation, because I know that if I charge the depreciation as per production units method, that will be a more fair presentation. So if there is such a permission to you in the framework, if there is a permission to you to either deviate from the requirements of the framework or to provide the disclosures beyond the requirements of the framework with the whole objective of achieving the fair presentation, that means fair presentation is the top priority there. Such a frameworks, I am going to call it as fair presentation frameworks. Understood? Clear? So compliance framework. So this is very, very important once again here. Why? Because at various places we are going to bring this discussion into picture. So especially in the reporting chapter. So what will be the requirements of the what will be your wording of the opinion in the case of compliance framework? What will be the wording of the opinion in the case of fair presentation framework? Very, very important. If you don't understand the difference between the two, you are going to do the mistake. So when it comes to compliance framework, what is the main objective here? Here in this framework, you have to strictly comply without any deviation. Deviation is not at all permitted. You are supposed to strictly follow whatever has been mentioned in the framework. Whereas when it comes to fair presentation framework, here objective is fair presentation. Achieving the fair presentation is the top priority. Okay. So tell me where there will always be a true and fair view. Where there will always be a true and fair view. In the fair presentation framework, there will always be a true and fair view is always guaranteed in the fair presentation framework. But when it comes to compliance framework, there might be a true and fair view. There might not be a true and fair view. Okay, so it all depends. We can't say always there will be no true and fair view. It all depends on the facts and circumstances. There could be a true and fair view. There might not be a true and fair view. But when it comes to fair presentation framework, there will always be a true and fair view given by the financial statements. Understood? So like this, we have totally discussed 4 frameworks. On the basis of purpose, frameworks are divided into 2 categories, general purpose and special purpose. On the basis of presentation, frameworks are divided into 2 categories. One is compliance framework, other one is fair presentation framework. This differentiation is very, very important. Why? Because as I was saying, the chapters are built on it. So why we have discussed about these different types of frameworks, where our discussion has started. So we are discussing the 2 broad opinions of the auditor. So number 1, I have told whether financial statements are free from material misstatements. Number 2, I have told you are required to express an opinion whether financial statements are prepared as per applicable financial reporting framework. So as a part of that objective, we have understood what is the meaning of the term applicable financial reporting framework, and we have understood what are the various types of framework. Now coming to the first objective, what is the first objective of the auditor? To express an opinion whether financial statements are free from material misstatements. So what do you mean by this material misstatements? So you are required to express an opinion whether financial statements are free from material misstatements. So we need to understand first what is the meaning of the term misstatement. So as we all are aware, what is the meaning of the term statement? Statement means conveying something. Misstatement means what? Conveying something in a wrong manner. Conveying something in a wrong manner. So misstatement in the financial statement means what? If I have to put it in very simple terms, a misstatement means a mistake in the financial statements. A mistake in the financial statements. Technically, I'm going to call it as misstatement. This is what the simple meaning. But we all know simple things don't work in the examination. We have to write the technical definition. Even the term misstatement has been technically defined in the standards. So how they have defined is the difference between amount classification, presentation, disclosure, which is there in the reported financial statements, and amount classification, presentation, disclosure, which is required as per applicable financial reporting framework. If there is a difference between the two, that difference only we call it as misstatement in the financial statements. So if there is a difference between amount classification, presentation, disclosure, in where? In the reported financial statements, the financial statements which are already prepared by the management. In that there is some amount, there is some classification, there is some presentation, there is some disclosure which is not matching with the amount required as per applicable financial reporting framework, which is not matching with, which is different from the classification required as per applicable financial reporting framework, which is different from the presentation required as per applicable financial reporting framework, which is different from the disclosure required as per applicable financial reporting framework. That we call it as misstatement. Like say for example, management in their financial statements, they have recognized the revenue as 10 lakh rupees. But as per some applicable accounting standard or Ind AS, the revenue should be recognized as 5 lakh rupees only. So there is a difference in the amount, that we call it as misstatement. Or in the financial statements which management has prepared, they have treated certain expenditure as capital expenditure, but as per the requirements of the applicable financial reporting framework, that has to be treated as revenue expenditure. Difference in classification, misstatement. Then difference in presentation. So company is required to prepare the financial statements in their vertical format of the balance sheet and P&L, but the management has prepared a horizontal format of the balance sheet and P&L. Difference in presentation. Once again, misstatement. Or even there could be a difference in disclosure also. Sir, what do you mean by disclosure? Whenever I say disclosure, I am referring to that explanatory information in the notes to accounts. Either as per some standard, as per some Ind AS, as per some As, you are required to explain certain information in the notes to accounts. Either you are not giving that explanation in the financial statements, or you are giving that explanation in a different manner, in a wrong manner. So if there is a difference in the disclosure, that also we call it as misstatement only. Able to understand? See here one important point which I want to bring it to all your attention. See, generally, whenever I say there is a mistake in the financial statements, whenever I say there is a mistake in the financial statements, one of the common perception, generally what you will imagine, say for example, I'm saying that there is some company X Limited. In that company X Limited's financial statements, there is a misstatement. So what you will generally imagine? So whenever I say misstatement, you generally imagine that there is a mistake in the balance sheet. Either assets are wrong, liabilities are wrong, or balance sheet is not matching, or profit figure is wrong, or cash flow statement is wrong. This is what generally comes to your mind. Yes, you are correct. But going forward, I want you all to change your perception. Whenever I say misstatement, misstatement need not be always quantitative. Misstatement need not always be numbers and figures. We have to change our perception. A misstatement can also happen in the notes to accounts. If the management did something wrong, give a wrong explanation in the notes to accounts, that is also a misstatement only. Misstatement need not always be quantitative. Misstatement need not always happen only in numbers and figures. Misstatement can even happen in the notes to accounts also. Where also the misstatement can happen, misstatement can also happen even in notes to accounts. And not just normal misstatements, very big pervasive misstatements can happen in the notes to accounts. So you have to be very careful. I want you all to change your perception. So going forward, whenever I say there is a misstatement in the financial statements, don't just imagine only numbers and figures. The misstatement could even happen even in notes, also in the explanatory information, in the qualitative information also misstatement could happen. Clear? So material misstatement. So next thing is, we need to be not worried about each and every misstatement. We need to worry about only those misstatements which is material. So now what is the meaning of the term material? Material means something which is significant, something which is important, something which is major. But as we all are aware, in the subject of audit, materiality is something which is subjective, which is very relative. So we can't exactly define this much amount will always be material. I can't define it. Like I can't say 1 crore amount of misstatement will always be material. I can't say it. Why? Because 1 crore of misstatement happened in the Reliance Industries Limited might not be material. Why? Because Reliance Industries Limited financial statements itself will be rounded off in crores. 6 lakh plus crores of revenue of a company. In that 1 crore amount of misstatement has happened. Not material. Take another company which is making 100 crores of turnover, their 1 crore worth of misstatement has taken place, then it becomes material. Same misstatement, same circumstances, same nature. But in one case it is not material, in another case it is material. So what I wanted to say here is materiality is something which is a very relative term. Materiality is something which is a very subjective term. It changes from person to person, it changes from entity to entity, it changes from audit to audit, it changes from circumstance to circumstance. So we can't absolutely define what is material in all the circumstances. It all depends on facts and circumstances of each and every case. More about determination of materiality, sir. How exactly you will determine what is material, what is not material, how exactly you are going to determine that, we will see it in a while when we take up the chapter risk assessment, internal control and materiality. There we will try to understand it. Okay. So, but as an auditor, you have to express your opinion whether financial statements are free from material misstatements. That means financial statements do not contain any material misstatement. So that you have to express your opinion. Understood? But one general term they have told, a misstatement can be considered as material if it could influence the decision of users of the financial statements. So how they have defined the term material misstatement? A misstatement will be considered as material if it could influence the decision of users of financial statements, then we can call that misstatement as material. So this definition, you just keep it at the back of your mind. So with this, we have completed two broader objectives of the entire audit. So let me see, is there anything else we have to quickly revise in this chapter? So we have covered all this. Misstatement we have covered, and one more thing. The misstatement can happen either because of fraud or error. A misstatement in the financial statements can either happen because of fraud or it can even happen because of error. We already know what is the distinguishing factor between the two. Fraud is something which is always intentional, whereas error is something which is unintentional. So material, legal form, all this we have covered. Now, what is the meaning of the term auditor? See, for audit is a process of doing independent examination, and the person, whoever is doing such independent examination, that person we call it as auditor. But when it comes to the audit terminology, when I say auditor, I am not referring to a single person. From the audit perspective, when I say auditor, if I am using the phrase auditor, I am not referring to one person, I am referring to a team. Generally, say for example, there is an audit firm, ABC and Co audit firm is there, which is set up by 3 partners who are practicing chartered accountants. Now, these people are having an office. In the office, there will be various staff available or not. Who and all will be the various staff available? See, there will be audit assistants like you, senior article assistants, and junior article assistants will be there. There will be somebody called paid assistants, nothing but this BCom, MCom qualified people, or the people who have not yet completed their CA final. Generally, they will be working with audit firms, whom we call them as paid assistants. There will be audit managers. So like that, different people will be there in the firm. Say for example, this firm is having a total 50 staff, they are having 50 resources, they are having some 20 article assistants, 10 paid assistants, some 10 audit managers, etc. Now, if this firm has got audit of the client X Limited, X Limited approached this company and asked them to do the audit. Do you think one single person go and do and handle the audit single-handedly and complete it? Definitely not. So generally what will happen is when a company approaches, when an entity approaches a firm and do the audit, a team will actually be assigned to that work. So now what this firm has done is they have selected one engagement partner, one of the partner, Mr. A. 3 partners are there. So one partner has come forward and told, okay, I will take up the responsibility for completing this audit. So now this person, we call him as engagement partner. And he has picked out of his entire 50 staff, he has picked some 5 senior article assistants, 4 junior article assistants, 3 paid assistants, 2 audit managers. So like that, a team of some 12 to 13 people he has selected. Now this team of 13 people will go and complete the engagement. What engagement? Not the engagement which will happen before marriage. Engagement is a very broad term. So they will go and complete the audit engagement. What they will go and complete? Audit engagement. So engagement term is very, very broader. So what do you mean by engagement? Engagement is a mutual obligation, is an agreement or a contract in which there is a mutual obligation between two persons. So even the engagement which you are aware, something which happens before marriage, even in that engagement also, it is a mutual obligation. Bride agrees to marry the groom, groom agrees to marry the bride. So similarly, if an auditor has agreed to provide the services to the client has agreed to pay the fees to the auditor. This is also a engagement where there is a mutual obligation. A doctor has agreed to provide the treatment to the patients. Patient has agreed to pay the fees to the doctor. Engagement. That doesn't mean both are going to marry. So the engagement which you know is not the only engagement. The term engagement is a very broader term. It includes any party, any obligation, any agreement or contract where there is a mutual obligation between two persons, that we call it as engagement. So even engagement, even audit is also an engagement. So this team of 13 people is responsible for going and conducting the audit engagement of the client X Limited. So this 13 people, I call them as engagement team. These 13 people, I call them as what? Engagement team. So whenever I say auditor, I am not referring to one person. Whenever I say auditor, I am referring to the entire engagement team. Whom am I referring to? I am referring to entire engagement team, not just one or two persons. When I say auditor, I am referring to entire engagement team here. Able to understand? And in my engagement team, engagement partner will be there, senior article assistants will be there, junior article assistants will be there, paid assistants will be there, audit managers will be there, or any other designation. If the firm is using any other designation, even that other designated persons also will fall under my engagement team definition. So whenever I say auditor, I am talking about entire engagement team except in two cases. Generally, when I say auditor, I am referring to entire engagement team, but in two circumstances, wherever I say auditor, I am referring to only engagement partner. In how many circumstances? In two circumstances, the reference to auditor means only reference to engagement partner. Sir, what are the two circumstances? Number one, acceptance of responsibility. Number two, accountability. So only in two circumstances, whenever I say auditor, I am not referring to entire engagement team. I'm referring only to engagement partner. So what are the two circumstances? Number one is acceptance of responsibility. Say for example, if somewhere it was mentioned, auditor has to sign the financial statements for accepting the responsibility. Now when I say here auditor, generally I told audit means entire engagement team. No. Do you think article assistant also can go and sign the financial statements? Just now as I've told, auditor means entire engagement team. No. If I told somewhere it was mentioned auditor is responsible for signing the financial statements, it is the act of acceptance of responsibility. Do you think a paid assistant or an article assistant can go and sign because he is also an engagement team member, he is also an auditor? No. Why? Because when it comes to acceptance of responsibility, auditor means only engagement partner. If somewhere it was mentioned auditor is responsible for signing the financial statements and taking the responsibility, there auditor means only engagement partner. Only engagement partner will sign, not everyone. Next, when it comes to accountability before regulatory authorities, say for example, if somewhere it was mentioned in some law, it was mentioned that auditor has to face imprisonment for 2 years. That means for your actions you have to become accountable. So say for example, one fine day you are an article assistant in one firm, your partner and you have done some audit. In that audit you are not able to find some mistake or you have done something wrong and police have come to arrest you and they came to the office. Your partner is not there. You are there sitting in your office. You are an article assistant. You are sitting there in the office. Can the police take you? Can they say, okay, even audit assistant is also a part of engagement team. Auditor means entire engagement team. So you are accountable. Let us come now. Can they pick the article assistants and grab him and take him to the station? No, they can't do it. Why? Because it is a matter related to accountability before regulatory authorities. In cases related to accountability before regulatory authorities, auditor means entire, not just entire engagement team, it is just an engagement partner. In rest of all the circumstances, wherever they are giving the reference to the term auditor, it means entire engagement team. But in these two circumstances, one is acceptance of responsibility and accountability before regulatory authorities. Auditor means only engagement partner. Clear? So this is what the basic information which we need to have in order to have a smoother discussion for the subsequent chapters. So we have successfully completed the intro part. We have successfully completed the intro part. Now we will pick up the next chapter for our revision, which is audit reporting. A very good weightage from this chapter Very important chapter from the examination perspective, very conceptual and very much easier to learn and understand also. Okay, shall we do it, everybody? So this chapter we'll try to do it now. Audit reporting, we will try to do it now. So just give me one moment. Right. Fine. So let us start now revising the audit reporting chapter. So very important chapter from the examination perspective. So very interesting, even from the practical perspective also it is very, very important. Very interesting discussion we are going to have. So not some routine and bragging discussion, very interesting discussion. And the content which we will learn here, that will help you practically also, that will even help you to get through the examination also. So having said that, let us set out the structure, what and all we are supposed to cover as a part of this entire chapter. Let us try to set the structure for this entire chapter. See, but before that, before I talk about it, I would like to explain few more things here before I talk about this reporting requirements and all. First, let us try to have a quick overview of entire process of the audit. What exactly happens in the entire process of the audit? Okay. So very, very important discussion. See this here, I'm going to tell you the entire cycle where the audit is going to commence, where the audit is going to end, in between what and all are the processes involved. I will give you overall structure, one basic structure I will give. See this structure we will revisit and make changes each and every time. Each and every time we add our concepts, we'll come back and add a few things in this entire process. Okay. See generally how the process of audit actually works is, number one, first client approaches auditor. Client approaches the auditor asking him to do the audit. So one day you are sitting in your office, a client has come to you and told, sir, we are so and so company, we want you to do the company audit for us. So whenever the client has came to you and asked you to accept some audit engagement, so here first before I accept and before I accept, I will perform certain activities. See, first of all, if a client is coming to me and asking me to do the audit for them, I need to determine whether I should accept that position. Whether I should accept that position, I will consider various factors like what is the status of my client, what is the nature, are they fraudulent people, are they genuine people, are they person of integrity or not, am I having capable resources to complete the engagement, will I be able to comply with the ethical requirements. So like that, various factors auditor will consider. Once he has considered all the various factors and if he has satisfied that okay, it will be fit for me to accept this client engagement, then only he will accept it. Okay, so a client is approaching the auditor asking him to do some engagement for him. Now you have to decide whether you will accept that engagement or not, depending on various factors which we will see it later as a part of this discussion. Then okay, and after you have accepted the audit, you have to be clear. You have to be clear about the terms and conditions. You have to be clear about terms and conditions. Why? Because like in any other commercial engagement, even in audit also, there is a chance of misunderstanding. In every commercial transaction, there is always a chance of misunderstanding. Do you agree with me or not? Yes. There might be misunderstanding with regard to payment. There might be misunderstanding with regard to deliverables. There might be misunderstanding with regard to the responsibilities. Audit is not an exception. Even audit is also a commercial transaction. So in audit also chances of misunderstanding are there. So you need to get clear with the terms and conditions of the engagement. So generally how we can get that clear understanding is by drafting something called engagement letter. In that engagement letter, you will write all the terms and conditions, the responsibilities of the auditor, responsibilities of the management. So what is expected from you, how you are going to give the report, all that terms and conditions you will agree. So basically what we will do first, as I have told, we will decide on accepting the relationship. Number two, we will draft the engagement letter. And there are few more formalities like communicating with the previous auditor, which you will see it in the subsequent chapter, professional ethics. Even we are required to communicate with the previous auditor once. We are required to communicate with the previous auditor. So like that, some formalities will be there. All that formalities we will fulfill. This I generally call it as preliminary engagement activities. What I will do? Preliminary engagement activities I will try to perform. So basically these are the activities which I will do even before I start doing the audit. Even before I start doing the audit, I will perform all these activities. If you see the examples, whatever I have told you here, like deciding whether to accept the relationship or not, drafting the engagement letter, communicating with the previous auditor, all this I have done even before I start doing the audit. So these activities I call it as preliminary engagement activities. So I perform all the preliminary engagement activities, and if I have accepted the audit, then the next step what I will do is I will plan. As I have told, this is not a full and final list, guys. Periodically we will come and make some changes wherever necessary, depending on the chapter we are covering. We will come back and make the changes to this structure. See, like any other activity requires the planning, even audit also we need to plan. Even audit also we need to plan. But in the case of planning of audit of the financial statements, there are three stages involved. One is establishing of audit strategy, other one is development of audit plan, and the final stage is development of audit program. Development of audit program. So I will do the planning. Along with that materiality determination and all also I will do. Like I have told, we need to fix the materiality. No, materiality is subjective term, I have told. So what is material, what is not material? So that materiality I will fix. I will do the planning, materiality fixation and all will happen. And whatever planning you have done, that planning should be executed or not. That plan should be executed. Basically, you will sit at the time of planning, you will sit and analyze, okay, these things I have to perform. These things I have to do. These activities I need to perform. So like that, you will do all the planning. And that plan needs to be executed. Basically, the execution phase of the audit, what we mainly do is we perform something called audit procedures. Execution is nothing but what? Performance of some procedures, which we call them as audit procedures. So what we try to do in the execution phase, we basically try to perform audit procedures. Sir, what do you mean by procedures? What do you mean by audit procedures? See, audit procedures is a very broad term. Audit procedures is a very broad term. It includes everything which you have done in the audit to obtain something called evidence. To obtain something called what? Evidence. Now, if I change here, if I divert from this structure for a while now, see, the ultimate objective of the auditor is to what? Express an opinion. Just in the previous session we have covered, just in the previous chapter we have covered, the ultimate objective, the final product of the entire process of the audit is to express an opinion. So that opinion you have to express. That is where the audit will come to an end. So this is the starting process. Client is approaching the auditor, asking him to do the audit. This is the starting process, whereas the last ending phase is expression of opinion. Now, like any opinion in this world requires some supporting information or not. Say for example, if you came to me and told, sir, I need an opinion on so and so person. You're coming to me and asking me, sir, do you know a person who is a chartered accountant? I want your opinion on him. See, if I have to give an opinion on a person, on an object, on a place, I should have some supporting information. Without information, just in fluke, I can't say anything, right? Even in the audit also, if I am expressing the opinion, that opinion should be based on some supporting information. That supporting information in the audit terminology, I call it as something called audit evidence. Audit evidence, I call it. So what do you mean by audit evidence? The information supporting the auditor's opinion. Like any opinion should have a supporting information. Even the auditor's opinion also should be supported by proper evidence. That evidence we call it as audit evidence. So only when we have audit evidence we can express the opinion. But just because you are an auditor, the moment you have been appointed as an auditor, automatically evidence will not come and fall in your lap. You need to perform some procedures. Just because you are appointed as an auditor, the evidence will not automatically come and fall in your lap. you need to perform some procedures from your end to obtain the audit evidence, which will give the basis for your opinion. And that procedures which we are performing to obtain the audit evidence, that procedures we call it as audit procedures. That procedures we are going to call it as what? Audit procedures. So basically, the procedures which you as an auditor have performed to obtain a sufficient and appropriate evidence, that we call it as opinion. That evidence, that procedures we call it as audit procedures. So this is what basically happens. This is what the overall structure, this is what basically happens in the entire audit process. But still, I'm telling you, this is not the full and complete chart. This requires various upgradations and updations over a period of time as we discuss the subsequent chapters. But for the time being now, so tell me what and all is involved here. First, the first step is the client approaches the auditor. Then you will perform some preliminary engagement activities. Then you spend your time for planning and determining materiality. Then that plan is required to be executed, and the execution of the plan actually happens by way of performance of audit procedures. By performing that procedures, you are going to get something called audit evidence, and based on that audit evidence, you are going to form an opinion. You are going to express an opinion. The moment you express your opinion, the process of audit will come to an end. The process of audit will get completed. Clear, everybody? See, now what we are going to do is we are going to hit the last part. So we are going to first understand the final product. See why? Because if you are clear about your final product, then you can streamline your procedures, right? Yes or no? See, for example, if you are a manufacturing concern, you are going to start a manufacturing entity. If you don't have clarity of your final product, how your final product should be, how much quality it should have, what standards it should have, so which customers it is going to tackle, unless you have a complete picture of your final product, will you be able to set up your entire manufacturing process? No. So even in the audit also, before we can go into the details of the what exactly going to happen in the entire process of the audit, it's always better to know what is our final product. So first we will become clear, first we will all become aware of what is the final product we are expecting. So what is the ultimate result we want, and then we will go into the procedural formalities. Okay. So now in the audit reporting chapter, I am going to talk about this final phase of the entire process of the audit, which is expression of opinion. Okay. So one thing we are all clear now, the ultimate objective of the auditor is to express an opinion. Sir, but how that opinion will be expressed? How that opinion will be expressed? See, when I say you are required to express an opinion, if I am an auditor, I am conducting audit of some company, my ultimate objective is to express an opinion. So how do I express that? Will I post a video on my YouTube channel? So I have this YouTube channel. Will I post a video here saying I am conducting audit of so and so company, I am giving an unmodified opinion? Do you think is it appropriate? Or can I go to the general meeting of the company, take the mic there and announce my opinion? I have conducted audit of this company and my opinion is this and that, blah, blah, blah. Can I speak out before the shareholders? Will it be worth? No. So when I say you have to express your opinion, that opinion should be in a written document. So whatever opinion you are required to express, that opinion should be in a written document, and that written document which contains the auditor's opinion, that we are going to call it as audit report. That we are going to call it as what? Audit report. So the ultimate objective of the auditor is to express an opinion, and the proper way of expressing the opinion is not orally or making a YouTube video or something like that. That opinion needs to be presented in a written format, and that written document which contains the auditor's opinion, that I'm going to call it as audit report. And how to prepare that audit report? I'm telling that final product, no, that final product of the entire process of the audit is audit report. And in this chapter, audit reporting, we are going to learn how to prepare this audit report, what should be the format of the audit report, what should be the contents of the audit report. That's what basically we are going to learn here. Everyone able to understand here? Right. So now how to prepare that audit report? Actually, we have some standards, 4 standards we have, which are actually talking about the format, structure and presentation of the audit report. Sir, which 4 standards are talking about the audit report? The 4 standards which are talking about audit report are: number 1 is SA 700, then we have SA 701, then we have SA 705, and after that we have SA 706. So these are 4 standards we have which are talking about audit report. What should be the format, what should be the contents, what should be the presentation, what should be the structure. Every discussion has been contained in this four standards. Okay, and not just this four standards, along with that we also have various sections of the Companies Act which are going to talk about how reporting requirements of the auditor. So we have 143 subsection 1 of the Companies Act, 143 subsection 3 of the Companies Act, 143 subsection 11, 143 subsection 12. So like that we have four subsections which are actually talking about the reporting requirements that also we are supposed to cover. So this is what the entire discussion which we are going to have in this chapter, audit reporting. So four SA 700 series of the standards, along with that a few subsections of section 143 of the Companies Act talking about the auditors reporting requirements. Okay, so first what we will try to do is we will try to hit with SA 700, which is the first and foremost standard in the SA 700 series, which is guiding us how to prepare the audit report. And the main subject matter of this discussion is how to prepare, what will be the contents of the audit report. That is the main objective and scope behind that SA 700. So let us try to understand what should be the format and what should be the contents of the auditor's report. Okay, so if you come to SA 700 here, if you come to SA 700 here, so these are all the contents of the auditor's reports. Or what should be the contents? Here we have the list of contents. Let us see here. So first there should be title. So even if we have a look at the practical reports also, so generally in our regular sessions and the EOB lectures, we take the help of the audit reports to make us understand here. Just give me one moment, whether for just for example sake, we will take one practical reports, because these days instead of asking the direct theory questions, they are asking the questions of drafting. Mainly they're asking questions of drafting in the audit reporting chapter, like they're asking you draft the opinion paragraph, draft the basis for opinion paragraph, draft the emphasis of matter paragraph, draft the other matter paragraph. So like that they are giving questions these days revolving around the drafting. To know the drafting, to get comfort of the drafting, we need to look at one practical example. So let us have a look at one practical example here. So just give me one moment, I will load any practical audit report here. Just give me 1 minute. Okay, so looks like I have to download. Just give me a minute. Okay, got it. Fine. Perfect. So here I have taken one audit report for the sake of our reference, which we can use it for the purpose of our discussion. So why I am putting the emphasis here on showing you that practical reports is, so as I was saying, in the recent days, instead of asking you the direct theory questions, they are asking the questions regarding drafting. So in order to know the drafting, we need to have a practical experience, right? So having said that, let me talk about the first and foremost thing. So contents of the auditor's report. Sir, what should be the contents of the audit report? So as I have told, audit report is a document through which we are expressing the opinion, but the standard did not leave it to our choice. Sir, how I have to draft the audit report, which paragraphs I have to use, what language I have to use. That freedom the standards have not given to us. The standard told, we will tell you the format, we will tell you the terminology, we will tell you the contents, we will tell you the paragraph. Simply follow it and give your audit report strictly in compliance with it. So SA 700, the first and foremost standard, forming an opinion and reporting on the financial statements. So this standard is giving us the contents. Let us try to understand each and every content in a detailed manner. Number one, first and foremost content in the audit report, there should be a title. Sir, what do you mean by title? There should be a proper heading for your audit report. Generally, the title of the audit report in the case of statutory audits is, they will use the title called Independent Auditor's Report. What title they will use? They will use a title called Independent Auditor's Report. So like that, one appropriate title or heading will be there. Then once you have given an appropriate title to your report, the next thing is addressing. See, basically, audit report is a document, is a kind of letter through which you are expressing an opinion. So there should be some address, when I say it is a letter through which you are expressing an opinion. Who is that addressee of the letter? So that addressee you have to mention. Generally, they are owners. Addressee will be the owners. Like in the case of a company, you will address that audit report to the shareholders or members. If it is a partnership firm, you will address your opinion to the partners. If it is a sole proprietor, to the concerned sole proprietor. So depending upon the legal form or structure of your client, you will decide accordingly who will be your addressee, appropriate addressee you will try to present it. So like even if we have a verification, even if we have a look here, as you could see, first there will be a title, Independent Auditor's Report, an appropriate title will be there. After that, addressee will be there. Addressee will be generally the members of the company. In the case of a company, it will be members, right? So first we will do this too. Title will be there, addressee will be there. Now immediately after that, the first and foremost paragraph in the auditor's report should be opinion. See, title and addressee, these are not opinions, these are something like headings. So the first and foremost paragraph in the audit report should be opinion. The standard SA 700 told, boss, you are giving the audit report to express your opinion. So first directly come to the point, tell us your opinion. After that, whatever you wanted to say it. So then comes the first and foremost paragraph in the auditor's report, which is opinion paragraph. Now, we need to have a discussion regarding opinion paragraph. So the ultimate objective of the auditor is to express an opinion. So let us try to have a quick understanding of different kinds of opinion. So guys, if you are already able to remember, I have divided the opinions into two broad categories. Like any other opinion, even auditor's opinion also can be broadly divided into two categories. What are the two broad categories of the opinion? Number one is unmodified opinion and number two is modified opinion. So if I have to put it in common parlance, unmodified opinion is something we call it as positive opinion, whereas modified opinion is something I can call it as negative opinion. So we need to become clear now when we will give unmodified opinion, when we will give modified opinion. So first I will talk about the easy one. We will give unmodified opinion when we have obtained sufficient and appropriate audit evidence that financial statements are free from material misstatements. And also we have obtained sufficient and appropriate audit evidence and we are satisfied that financial statements are prepared as per applicable financial reporting framework. So when we have performed our audit procedures and we have obtained sufficient and appropriate audit evidence, what evidence we have obtained? That financial statements are all free from material misstatements and also the financial statements are prepared as per applicable financial reporting framework. Basically, when we have obtained evidence regarding the two objectives, whatever we have seen in the introduction part. So if we are satisfied with the two objectives, we give something called unmodified opinion. And there are other names for this unmodified opinion. We also call it as unqualified opinion, or even we call it as clean opinion also we can call it. Clean opinion, unqualified opinion, unmodified opinion, whatever you wanted to call it, you can call it. Sir, now what kind of terminology I have to use? What kind of terminology I have to use? Why? Because if you are giving unmodified opinion, since we are going through all this formal education, since we are learning all these standards, we will get to realize when we say unmodified opinion, we chartered accountants can realize that, okay, this is a genuine, this is a positive opinion. But can you expect everybody to understand in the same manner? Why? Because everybody is not learning the standards on audit, right? So that's why we can't overcomplicate the readers by using this technical terminology. The standard told, if you are giving unmodified opinion, we will give you the phrases, use only that phrases. What the standard has told, if you are giving an unmodified opinion, we will give you the phrases which you have to use only those phrases. Sir, what are those phrases I have to use? So the standard says you are required to use the phrase that financial statements are giving a true and a fair view. So however, if I put it in different way here, so if you are giving unmodified opinion, how to use the phrases in your opinion paragraphs is, it depends on whether you are reporting on the financial statements prepared as per fair presentation framework. It also depends on whether you are reporting on the financial statements which are prepared as per compliance framework. As I have already told, if it is a fair presentation framework, my objective will be, the objective of the fair presentation framework will be to achieve fair presentation. Whereas compliance framework, the objective of the compliance framework is a strict compliance. So if I am conducting audit of the financial statements prepared as per fair presentation framework, and if I have performed all my audit procedures, if I am satisfied that financial statements are prepared as per applicable financial reporting framework, financial statements are free from any kind of material misstatement, if it is a fair presentation framework, I have to use the phrases financial statements give a true and fair view, or alternatively, what phrase you can use as financial statements are present fairly in all material respects, that too in accordance with the applicable financial reporting framework. Why? Because we expect, if we are reporting on the financial statements prepared as per fair presentation framework, my objective there is to check whether that financial statements are giving true and fair view. So if I am satisfied that everything is okay with the financial statements, I have to use any of these phrases. Which phrase I have to use? Either I have to use the phrase financial statements are present fairly in all material respects, or alternatively I can use the phrase financial statements give a true and fair view. On the other hand, if I am reporting on the financial statements which are prepared as per compliance framework, here I have nothing to do with the true and fair view. I am required to only comment whether they are prepared as per the financial reporting framework. I have nothing to do with checking the true and fair view. So here I need to check only whether they are strictly prepared in compliance with the compliance framework. So in case if you are conducting audit of the financial statements prepared as per compliance framework, and if you are satisfied, yes, the financial statements are prepared as per the compliance framework, then then which of phrases you have to use here is, so you have to use the phrase something like this: accompanying financial statements are prepared in all material respects in accordance with applicable financial reporting framework. Here you are not supposed to say anything related to true and fair view, because that is not our objective in the compliance framework. But in case if you are conducting audit of the financial statements prepared as per fair presentation framework, any of these two phrases we can use. Either we can use the phrase financial statements are present fairly in all material respects, or you can alternatively use the phrase financial statements give a true and fair view in accordance with applicable financial reporting framework. And if you see here in the compliance framework, there is no reference given for true and fair view, because that is not required in the compliance framework. Able to understand? Clear and comfortable, everybody? So this is what regarding unmodified opinion. Okay, so when we will give unmodified opinion, when we have obtained sufficient and appropriate audit evidence, and when we are satisfied that the financial statements are free from material misstatements and they are prepared as per applicable financial reporting framework. Okay, so even if we have a look at the practical discussion, so even if you look at here it is an opinion of the auditor on this fair presentation framework. Generally, whatever financial statements which companies will release, all that are fair presentation framework. So here if you see, the auditor has given the opinion. If you look at the opinion paragraph, as I've told, drafting is very important. So everywhere you look at the opinion paragraph in the audit report, it will contain two subparagraphs. Everywhere the opinion paragraph will contain two subparagraphs. The first subparagraph, I will come back to that later. The second subparagraph will actually contain the opinion of the auditor. So let us see what the auditor is saying here. In our opinion, and to the best of our information and according to the explanation given to us, the aforesaid standalone financial statements give all the information required by the Companies Act and in the manner so required, and they give a true and fair view in conformity with the accounting principles of the state of affairs and also the profit. So the most important thing where you have to pay attention here is what phrase the auditors of Reliance have used. They have used the phrase that the financial statements are giving a true and fair view. So that means what kind of opinion it is? Unmodified opinion. See, nowhere in this paragraph you will be able to find the term unmodified, but still we are able to identify this is an unmodified opinion. How come we are able to identify that this is an unmodified opinion? With the help of this terminology. Able to understand? Right. Now, let us come back to the other discussion. Sir, modified opinion. When we will give modified opinion? See, basically, if I put it in very simple terms, if the auditor is not satisfied with the true and fair view, if the auditor is not able to obtain, if the auditor is not satisfied that financial statements are free from material misstatements, or if the auditor is not satisfied that financial statements are prepared as per applicable financial reporting framework, or when the auditor is hesitant to say that financial statements give a true and fair view. That means auditor doesn't want to say financial statements are giving true and fair view because he found something wrong. He had some trouble in saying that. Then auditor will bring a negativity in his opinion. So whenever the auditor brings a negative comment in his opinion, that opinion we are going to call it as modified opinion. Technical definition of the modified opinion, we will come back to that later. But one basic concept you have to understand here, when the auditor doesn't want to give a completely positive opinion, when he is having some trouble in saying that, that means when he found something is wrong in the financial statements, then he will give a modified opinion. So before we look at the definition of the modified opinion, so let us try to understand the three kinds of modified opinion. So there are three kinds of modified opinion. So what are the three kinds of modified opinion? Number one is qualified opinion. Then number two, we have adverse opinion. And number three, we have disclaimer of opinion. So we need to understand when the auditor will give qualified opinion, when the auditor will give adverse opinion, and when the auditor will give disclaimer of opinion, that we will try to understand. So if I give you the quick revision of all these three opinions, the qualified opinion can be given in two cases. Qualified opinion can be given in two circumstances. Sir, what are the two circumstances? Circumstance one, auditor has obtained sufficient and appropriate audit evidence. So auditor obtained sufficient and appropriate audit evidence. It is available. Auditor was able to perform audit procedures. He was able to obtain audit evidence. And depending on that audit evidence, he concluded that financial statements contain a misstatement. He concluded that financial statements contain a misstatement. There is a misstatement in the financial statements. So what is there? There is a misstatement. He found some mistake in the financial statements. And he concluded that the effect of the misstatement is only material and not pervasive. Misstatement is material. So he performed audit procedures, he obtained sufficient and appropriate evidence. On the basis of that evidence, he concluded that financial statements contain a what? Misstatement. A misstatement is there in the financial statements. The effect is material, but it is not pervasive. Sir, what do you mean by pervasive? Pervasive technical definition, we'll come back to that in a while. But the meaning of the pervasive, the general meaning of the term pervasive is a misstatement will be considered as pervasive if it is big enough to say financial statements are completely wrong. If I have to even put it in simple terms, very big misstatements, I call it as pervasive misstatements. So here what is happening is auditor has performed audit procedures. He obtained audit evidence. On that evidence, he concluded that financial statement contain a misstatement. That misstatement is material. Yes, that is significant effect. That is significant enough. But is it very big? No, it is not very big. In that cases, auditor will give something called what? Qualified opinion. So this is one case where auditor will give qualified. So one more case where auditor can give qualified opinion is auditor is unable to obtain sufficient and appropriate audit evidence. The auditor is unable to perform audit procedures, and because he is unable to perform audit procedures, he is unable to obtain audit evidence. Like if I give you some example, if I give you one quick example to make you understand, say I am conducting audit of this balance sheet of the company. So there are fixed assets, there are current assets. Under current assets, I have inventory, trade receivables, cash and cash equivalents. So like that, various assets I have. And liabilities also I have, share capital I have, reserves and surpluses I have, long-term borrowings I have, short-term borrowings I have. See, I am able to perform audit procedures on every item. I'm able to obtain evidence regarding share capital. I'm able to obtain evidence regarding reserves and surpluses. I'm able to obtain evidence regarding borrowings. Fixed assets, I was able to obtain evidence. Trade receivables, I was able to obtain evidence. Cash and cash equivalents, I was able to obtain evidence. But this inventory, I am unable to obtain sufficient and appropriate audit evidence. There is a place where the inventory has been kept. At that inventory, there is a very bigger figure here. Say, for example, total inventory amount is 50 crore rupees. Out of that, 5 crores worth of inventory was kept in a warehouse. That warehouse I can't go and physically verify because of some calamity. One quantity of stock worth amounting to 5 crore rupees was kept in a warehouse, which I was unable to visit to obtain that evidence. So that's why I was unable to obtain that evidence. So here, if you look at this typical scenario, auditor is unable to obtain sufficient and appropriate audit evidence. And if at all the matter regarding which I am unable to obtain evidence, regarding 5 crores worth of inventory, I am unable to obtain evidence. If at all this goes wrong, 5 crores I am unable to obtain evidence. So I am assuming if at all this 5 crores of stock itself is not there, what will be the possible effect? So here I have to use the phrase possible effect. So I am unable to obtain sufficient and appropriate evidence, and the possible effect. Why I am using the phrase possible? Because I don't have evidence. I am estimating. The possible effect of the matter regarding which I am unable to obtain evidence is material. If that 5 crores goes wrong, that is material, but it is not pervasive. It is not a very big misstatement to say financial statements are completely wrong. Then also I will give qualified opinion. Then also I will give what? Qualified opinion. So broadly, qualified opinion can be given in two cases. Number one, auditor is having sufficient and appropriate audit evidence available. On the basis of that evidence, he has concluded that financial statements contain a misstatement whose effect is material but not pervasive. On the other hand, auditor is unable to obtain sufficient and appropriate evidence whose possible effect, see, wherever, this is very, very important. These phrases are very important. This terminology is very important. This is what will either give you the marks or this is what will make you lose the marks. So you will feel that you have written everything correctly, but you will not use the proper terminology. That's why you don't get the expected marks here. So here I have to use the term possible effect. Whenever sufficient and appropriate audit evidence is not available, you have to use the phrase possible effect. If you don't use a possible effect, gone. You will not get the marks. So I am unable to obtain sufficient and appropriate audit evidence, and the matter which I am unable to obtain evidence, if that goes wrong, the possible effect is material but not pervasive. Then I will give something called qualified opinion. And how to identify the qualified opinion is, what kind of phrase I have to use is, I have to use the phrase something like this: except or subject to certain items. Except or subject to certain items. If it is a fair presentation framework, I will say financial statements give a true and fair view or present fairly. Or if it is a compliance framework, I will say except or subject to certain items, financial statements are prepared as per compliance framework. So if you look at the terminology here, if I am giving qualified opinion, I am saying that except or subject to certain items, financial statements give a true and fair view. Guys, you tell me, is it a completely positive opinion? Am I saying completely financial statements are giving a true and fair view? The answer is no. I am not completely saying financial statements are giving a true and fair view. At the same time, am I giving a completely negative opinion? Am I saying financial statements are completely wrong? No. It is a positive kind of opinion with a slight negative comment. It is not a completely positive opinion. It is not a completely negative opinion. It is a positive opinion with a negative comment attached to it. So that is what we call it as qualified opinion. So how to identify the qualified opinion? What terminology you have to use? So if I show you the terminology here. So these are different kinds of modified opinion have been explained in SA705. So if you come to SA705 here, this is what the terminology you have to use, except for the effects of the matters which are described in basis for qualified opinion section. That means except for certain items, financial statements give a true and fair view or they present fairly in all material respects. That means there are a few things are there, few negative things are there. Apart from that, financial statements are giving a true and fair view. Understood? And in two cases, you are supposed to give qualified opinion. Okay. So this discussion, qualified opinion discussion, we have completed. Now let us talk about one more discussion, which is adverse opinion. Now we will talk about adverse opinion. Sir, when auditor will give adverse opinion? So the auditor is supposed to give adverse opinion when he is having sufficient and appropriate audit evidence available. Evidence is there. And on the basis of that evidence, auditor has concluded that financial statements contain a misstatement. On that basis, he has concluded that financial statements contain a misstatement, and the misstatement, the effect of the misstatement is material. It is significant enough, and it is not just a material, it is even a pervasive misstatement. It is a very big misstatement. What is pervasive? I will tell it in a short while. But auditor has performed audit procedures, and by performing that audit procedures, he has obtained a sufficient and appropriate evidence. On the basis of that evidence, he has concluded that financial statements contain a misstatement. The effect of that misstatement is not just a material, the effect of that misstatement is pervasive. It is a very big misstatement to say financial statements are completely wrong. So in those cases, auditor will give adverse opinion. And what kind of terminology you are supposed to use when you are giving adverse opinion is, you have to use the phrase, you have to say directly, it is completely negative. Adverse opinion is something which is completely negative. The auditor will say financial statements do not give true and fair view. Straight away, complete negative, he will say financial statements do not give a true and fair view. Straight away, completely negative comment he will give it. Able to understand? So if you come back here, adverse opinion will be given in only one case. See, if you have to say something is completely wrong, you can say it only when you have evidence. So that's why for giving adverse opinion, having sufficient and appropriate evidence is a must. So auditor will give adverse opinion when he is having obtained sufficient and appropriate audit evidence and concluded that financial statements contain a misstatement which is material and also pervasive. And what phrase he will use in the opinion paragraph? So because of the significance of matters explained in basis for adverse opinion paragraph, the accompanying financial statements do not present fairly, or they do not give a true and fair view. Next one. Right. Next one, disclaimer. Sir, when auditor will give disclaimer? So let us have a look at when auditor will give disclaimer. So auditor will give disclaimer of opinion when the auditor is unable to obtain sufficient and appropriate evidence. He is unable to perform audit procedures. He is unable to obtain sufficient and appropriate audit evidence. And as I have already told you, when you use the phrase evidence is not available, you have to use the phrase possible effect. Why? Because we don't know, we are assuming. So auditor is unable to obtain sufficient and appropriate audit evidence, and the possible effect of that undetected misstatements. Possible effect of that undetected misstatements is not just a material, it will also be pervasive. So if I give you an example for this, if you come back to this here once again, say for example, I am conducting audit of this balance sheet. I am unable to obtain evidence regarding fixed assets. I am unable to obtain evidence regarding inventory. I am unable to obtain evidence regarding trade receivable. I am unable to obtain evidence regarding cash and cash equivalents. Multiple items I am unable to obtain evidence. If at all these items goes wrong, what will be the possible effect? Will it be only material, or will it cause a very big pervasive misstatement? It will cause a very big pervasive misstatement. So I am unable to obtain sufficient and appropriate audit evidence, and the possible effect of that undetected misstatements is not just going to be material, it is a material as well as pervasive. This material as well as pervasive. Then the auditor will give disclaimer of opinion. And how to identify that disclaimer of opinion is auditor disclaimer. The name itself says disclaimer means what? Stopping yourself. So how to identify the disclaimer of opinion is auditor will use the phrase we do not express an opinion on the financial statements. What phrase auditor will use? We do not express an opinion. Because we are unable to perform audit procedures, we are unable to obtain sufficient and appropriate audit evidence, we will not be able to express an opinion, or we do not express an opinion. The moment you find this phrase, that will be a disclaimer of opinion. So when auditor will give disclaimer of opinion, when he is unable to obtain sufficient and appropriate evidence, and when the possible effect of that undetected misstatement is not just a material, it is also pervasive, then the auditor will give disclaimer. And what phrase he will use here? So if you look at it here, he will use the phrase we are not able to obtain sufficient and appropriate audit evidence. Clear and comfortable, everybody? So these are all three kinds of modified opinion, and if you pay close attention here, in every kind of modified opinion we have a negative remark. Qualified opinion, little severe negative remark. So I will say here all these three, qualified, adverse, disclaimer, all three are negative opinions. But how can I differentiate that? Is the severity of the negativity is changing. What is changing? Severity of the negativity is changing. Qualified opinion is a negative opinion, but severity is very less severe negative opinion. Why? Because I am saying that except certain items of financial statements give a true and fair. Whereas adverse and disclaimer are extremely severe negative opinions. Adverse and disclaimer are extremely severe negative opinions, because I am saying that in the adverse opinion, I am saying financial statements do not give true and fair view, they are completely piece of shit. Whereas in the case of disclaimer of opinion, I say that I am not able to express an opinion. Both are extremely severely negative, whereas qualified opinion is a less severely negative opinion. Understood? So whatever it is, first, why we have come to here, why we are discussing this? So why? Because we are discussing the contents from SA 700. There they told the first content is title, the second content is addressee, the third content is opinion paragraph. So we are understanding different kinds of opinion. We have understood broadly two categories: unmodified, modified. So unmodified was explained in SA 700 only. The different kinds of modified opinion, like this, what is qualified, adverse, a disclaimer, all this discussion whatever we had till now, these different kinds of modified opinion and all, this is what the discussion contained in SA 705, modifications to the auditor's opinion. So whatever it is, you have to express your opinion. First you have to arrive at your opinion, whether you want to give qualified or whether you want to give unmodified or you want to give modified. If you want to give modified, which kind of modified opinion you want to give, either qualified, adverse or disclaimer. And one more important thing here, say for example, if you have decided some important conceptual things I'm going to say here, important from the examination perspective, particularly for MCQs here. See, once you have decided that you will give modified opinion, once you have decided that you will give modified opinion, but which kind of modified opinion you have to give, either you have to give qualified opinion or you have to give adverse opinion or you have to give disclaimer of opinion. This decision will depend on only two factors. This decision will depend on only two factors. Once you have decided you want to give modified, but whether you will give qualified, whether you will give adverse, whether you will give disclaimer, that is going to depend on two factors. Number one is availability or non-availability of evidence. The first factor is availability of evidence, whether evidence is available or evidence is not available. Other one is pervasiveness of the misstatement, whether the misstatement is pervasive or not. So these are the only two factors. Even you can look at this chart also. There are only two factors which will decide which kind of modified opinion I will give. Number one, availability or non-availability of evidence. Number two, what is the pervasiveness of the misstatement. Just these two factors will be enough for me to determine which kind of modified opinion is going to be appropriate. Understood? And one more thing here, before I proceed further with the next contents, one more thing I would like to bring it to your attention here. Sir, you are telling misstatement pervasive or not? No. What is the definition of the term pervasive? What is the meaning of the term misstatement? What is the meaning of the term pervasive? See, pervasive is a term which is used in the context of the misstatements. In the context of the misstatements, to describe the effect of either misstatements or possible effects of the misstatements, we use the phrase pervasive. And they say that we can call a misstatement to have a pervasive effect. Number one, if it is not confined to specific elements, if the misstatement is not restricted to one or two items, if the misstatement is spread across so many items, then we can call it as pervasive. Or even if it is confined, sometimes a misstatement will be confined to a single item, but it could represent or it represents or it could represent a substantial portion of the financial statements. Like say for example, I am conducting audit of some company, fixed assets 100 crores are there. Under current assets, I have inventory amounting to 50, trade and trade receivables 30, cash and cash equivalents 20, total 200. See, if I find misstatement in all the items, if it is not confined to one item, if it is spread across multiple items, I call it as pervasive. Sometimes what will happen is misstatement will be confined to only one single item. Misstatement will be confined only to single item. Say for example, misstatement is there only in fixed assets, but the amount of misstatement is 80 crore. Then also I call this as misstatement. Then also I call this misstatement as pervasive. Why? Because even the misstatement is confined to a single item, it is representing a substantial portion. It is representing a very big portion of the financial statements. Then also I can call this misstatement as pervasive. Or a misstatement can be considered as pervasive if that misstatement relates to such a disclosure which are fundamental to users' understanding of the financial statements. So if the management has made a mistake in those disclosures of the financial statements which are very fundamental to users' understanding of the financial statements, like for example, if the management for example, if the management has made some mistake in the going concern disclosure, management is giving some wrong disclosure relating to the going concern assumption, then that misstatement will be considered as pervasive. So that's what I was saying, guys. Whenever I say misstatement, don't just imagine the quantitative, that is the misstatement in numbers and figures. Even misstatements can happen in notes to accounts, not just ordinary misstatements. A very big amount of misstatements, pervasive misstatements can happen in the notes to accounts. So this definition is very important. So you tell me when a misstatement can be considered as pervasive. Number one, if it is not confined to specific elements of the financial statements. Number two, even if it is confined to specific elements, it could represent a substantial portion of the financial statements. Number three, if the misstatement relates to those disclosures in the financial statements which are very fundamental to users' understanding of the financial statements. So whatever it is, we will say our opinion in the opinion paragraph. Either it is qualified, adverse, disclaimer, unmodified. So we will say our opinion. And as I was saying, in the opinion paragraph, we tell about our opinion in the second sub paragraph. But the standard SA 700 says that in addition to the opinion, should also tell some extra information, some compulsory information you should say along with your opinion. So two sub paragraphs are there here. In the first paragraph, some compulsory information should come. In the second sub paragraph, opinion will come. So what should be the second sub paragraph? We have understood. Now what information is there in the first sub paragraph? That let us try to understand it here. So once again, if you come back to the contents here, they say that if you come back to the detailed explanation, yes, here. So what should be the contents in the opinion paragraph? So definitely in the opinion paragraph, we will say our opinion. In addition to our opinion, we should also mention certain extra information in our opinion paragraph. As you could see here, number one, identify the entity. That means you have to mention the name of the entity whose financial statements you are conducting the audit. Number two, you have to mention the fact that financial statements have been audited. You have to mention one statement that financial statements have been audited. Number three, you have to mention the title of each component comprising of the financial statements. Like you have to say financial statements contain balance sheet, P&L, statement of changes in equity, cash flow statement, notes to accounts, etc. And even you have to give a reference to the notes, and you should specify the date or period covered by each financial statement comprising the financial statements. So these are 5 items must come in my opinion paragraph. So what are the 5 items? Along with the opinion. These are along with the opinion. So along with the opinion, these are the 5 things which must come in my opinion paragraph. Number one, you have to identify the entity whose financial statements you are audited. You have to mention the fact that financial statements have been audited. You have to mention the title of each of the items of the financial statements. You have to give a reference to the notes. You have to specify the date and period covered by the financial statement items. That's what you will be able to find it in this first paragraph. Okay, right. So after the opinion paragraph, right, 3 contents we have successfully completed: title, addressee, and opinion. Now let us come to the next paragraph. So once we have given this opinion paragraph, the next one comes, which is basis for opinion paragraph. What is the next one? Basis for opinion paragraph. See, you have told your opinion, but why anybody should rely on your opinion? If you let them know on what basis you have expressed your opinion, then the people will be able to rely on your opinion. Sir, what exactly I should mention in my basis for opinion paragraph? The standard says, SA 700 says, in your basis for opinion paragraph, 4 things you must mention. How many items you have to mention in my basis for opinion paragraph? 4 things we have to compulsorily mention in my basis for opinion paragraph. What are that 4 things? Number one, that you have done the audit as per standards on audit. Number two, you have to describe the auditor's responsibility. You have to say that we have one more paragraph. Generally, if you look at the contents, we have something called auditor's responsibility paragraph. So you have to say that there is one more paragraph called auditor's responsibility. There we have explained all our responsibilities. Like that, you have to give a reference to the auditor's responsibility paragraph. Next, you have to mention a fact that you are independent of the entity and also you are complying with ethical requirements. And also you should say that you have obtained sufficient and appropriate audit evidence. You should also mention that you are giving a sufficient and appropriate evidence. Able to understand? So 4 things must come in my basis for opinion paragraph. What are the 4 things which must come in my basis for opinion paragraph? So if you have a look at the practicality, so if you see this basis for opinion paragraph, they are telling that we have conducted the audit as per the standards on audit. First point covered. Then our responsibilities are further described in auditor's responsibility paragraph, reference to auditor's responsibility paragraph given. Third one, they are saying we are independent of the company and even we complied with ethical requirements. Third point, and we believe that we have obtained sufficient and appropriate evidence. So these 4 things must come in my basis for opinion paragraph. Now, see, these 4 things must come in my basis for opinion paragraph if I am giving a unmodified opinion. So if I am giving an unmodified opinion, in my basis for opinion paragraph, whatever 4 things I have explained, that only will come. But in case if I am giving a modified opinion, when I say modified, it could be qualified also, it could be adverse also, it could be disclaimer also. So if I am giving any of this modified opinion, then what will happen is in my basis for opinion paragraph, in addition to that four matters, whatever we have read just now, even you have to explain the reason why you are giving qualified, why you are giving adverse, why you are giving disclaimer. That reasons also you are required to explain. If you are giving unmodified, your basis for opinion paragraph will contain only the four things which we have discussed now. But in case if you are giving modified opinion, either qualified or adverse or disclaimer, in addition to that four things, even you have to explain the reasons why you are giving a modified opinion. That reasons also you have to explain. And what exactly I have to explain the reasons is, if you come back to the SA 705 here, so what changes I have to make to the basis for opinion paragraph if I am giving a modified opinion. So if you come here, so changes to be made to the basis for opinion paragraph in case if you are giving a modified opinion. So first thing, we have to change the heading. So in both, for both opinion and modified basis for opinion, we have to change the headings, which means if we are giving unmodified opinion, the title of the opinion paragraph will just remain opinion. Basis for opinion paragraph title will just remain basis for opinion. But if I am giving modified opinion, the titles of the opinion and basis for opinion paragraph should change. If I am giving qualified opinion, the opinion paragraph heading will be qualified opinion. Basis for opinion will change to basis for qualified opinion. If I am giving adverse opinion, my opinion paragraph title will be adverse opinion, whereas basis for opinion will change to basis for adverse opinion. The same thing will happen even for a disclaimer of opinion. Disclaimer of opinion, basis for disclaimer of opinion. So if I am giving a modified opinion, the title of the opinion and basis for opinion paragraph should change accordingly. And not just that, what else they say? Amend the heading, so that we have already said that description and quantification of the misstatement. So in your basis for opinion paragraph, if you are giving a modified opinion, you have to describe the misstatement because of which you are giving a modified opinion, and not just describing the misstatement, even you have to do quantification. Even what you have to do, quantification. Quantification means what? You have to determine the amount of the misstatement. That amount of the misstatement also you have to mention in your basis for opinion paragraph. Sir, so and so misstatement has happened in inventory. That alone will not be enough. What is the amount of misstatement? Quantify and mention it. Sir, if I am unable to quantify, sometimes because of practical reasons, because of difficulties, you might not be able to exactly quantify the misstatement, then you have to mention that fact. If you are able to quantify, quantify and tell the figure. If you are not able to quantify, mention the fact. If it is not practicable to quantify, mention the same in the section. Then sometimes I will be modifying my opinion because of narrative disclosure. Narrative disclosure means what? In the notes to accounts, management has done a mistake. That's why I'm modifying. If that is the case, you have to explain the basis for opinion paragraph. Explanation of how the disclosures are stated. What wrong disclosures management have given, that you have to explain it in the basis for opinion section. If you are modifying your opinion because of non-disclosure, you might also be required to modify the opinion because management is not disclosing certain items. If you are modifying the opinion because management is not giving a disclosure, then you have to explain that non-disclosure. Then you have to first discuss that non-disclosure with those charged with governance, and you have to explain in the basis for opinion which information was omitted, and unless there is a prohibition from law or regulation, include that omitted disclosure in your basis for opinion section. If there is no prohibition from law or regulation, you have to explain what should have been the disclosure in the notes to accounts. That disclosure as it is, you present it in the basis for opinion. This disclosure, management exactly in this manner they should have given it, but the management did not give that disclosure. This omitted disclosure, you have to include it. Next, if modification results from inability to obtain evidence. Now, one more thing here. See, I told that 4 general things should come in my basis for opinion paragraph. What are they? Number 1, standards on audit. Number 2, you have to give reference to auditor's responsibility paragraph. Number 3, you say that you have to comply with ethical requirements and independent of the entity. Number 4, you have to say that you have obtained sufficient and appropriate evidence. These 4 things will come in my basis for opinion paragraph. But the standard has specifically told that if you are giving a disclaimer of opinion, your basis for opinion paragraph should not contain the last point. Quite logical, no? Why? Because we are giving disclaimer of opinion because we are unable to obtain sufficient and appropriate evidence. So that's why if you are giving a disclaimer of opinion, your basis for opinion paragraph need not contain this last point, that you have obtained sufficient and appropriate audit evidence. That point you should not include. Similarly, you need not include reference to auditor's responsibilities also. Why? Because in the case of disclaimer of opinion, our auditor's responsibility paragraph also will be very, very limited. We will not give detailed explanation. We will give very limited information in our auditor's responsibility paragraph. We will see it later in the subsequent part of the standard. But when you are giving disclaimer of opinion, in the out of that 4 points which must mandatorily come in my basis for opinion paragraph, 2 need not come. You need not give reference to auditor's responsibilities, and you need not say that you have obtained sufficient and appropriate evidence. That means if you are giving disclaimer of opinion, your basis for opinion along with the reasons why you are giving disclaimer, it will contain only these 2 information, that you have done the audit as per standards on audit and you have complied with ethical requirements and independent requirements. Very, very important from the examination perspective. Next. Yeah, that is what this 6th point is trying to say here. Understood, everyone? So this is what regarding opinion and basis for opinion paragraph. Once again, let us go back to SA700, try to understand the next content. So we have covered 4 contents till now. We have understood title, addressee, opinion, basis for opinion. Then we have a paragraph called material uncertainty relating to going concern. Sir, what is this paragraph? What kind of content will come under this paragraph? This we will discuss when we take up the standard SA 570. So when we take up the standards on auditing chapter, we discuss about SA 570. There I will tell you what exactly will come under this paragraph. So this you can leave it for the time being now. Then 6, 7 and 8, this we will have a separate discussion. First we will complete 700 and 705 completely. So once we are done with 700 and 705, then we will pick up SA 701 and SA 706. There we will have a dedicated discussion regarding what is the key audit matter, what is the emphasis, what is other matter paragraph. At that point of time, we will have a dedicated discussion. Okay, so these paragraphs will have dedicated discussion. After all that, next paragraph which will come in my audit report is responsibilities of management. So in your audit report, you have to include a paragraph where you have to explain what will be the responsibilities of the management. So what exactly I will try to mention here in that responsibilities of the management for financial statements, 4 things should come here. So as you could see, you have to say that the management is responsible for preparing the financial statements. Sir, what information I have to mention that they are saying in that responsibility paragraph? Number 1, you have to say that the management is responsible for preparation of financial statements, that too in accordance with applicable financial reporting framework. And you should also mention that the management is responsible for implementation of internal controls. And also you have to mention that the management is responsible for assessing the entity's ability to continue as a going concern, whether entity will be able to continue as a going concern or not, whether they will be able to continue for the next 1 year or not. Making that assessment is also the management's responsibility. And also you have to identify who is having oversight of the financial reporting process. Basically, who is looking after that financial reporting process, that people also have to identify. In case if those charged with governance is looking after the financial reporting process, that you have to identify. So these are 4 things must be mentioned in the responsibilities of the management paragraph. What are they? Number 1, they are responsible for preparation of financial statements. They are responsible for implementation of internal control. They are responsible for assessing entities' ability to continue as a going concern. Even you have to mention who is responsible for oversight of the financial reporting process. So after this audit, after these responsibilities of the management, then you have to include a paragraph where you are supposed to explain what are auditor's responsibilities. You have to explain. Why? Because not just management will be having the responsibilities, even auditor also will have a lot of responsibilities to fulfill. So here the list will be never ending, not that important from the examination perspective regarding auditor's responsibilities. I will tell you which aspects regarding auditor's responsibilities are important. I will tell you. So like if you have a look here, so many things where the question will come in the auditor's responsibilities that I will focus. Remaining will just try to have a brief. Like if you see the auditor's responsibility paragraph here, the list is very lengthy. Like you have to mention all your responsibilities, like you have to obtain reasonable assurance, you are responsible to issue an audit report. Reasonable assurance is a high level of assurance but not a guarantee. And you are worried about material misstatements, and when misstatements will be considered material, that you are required to exercise professional judgment, you are required to maintain professional skepticism, you are required to identify and assess the risk of material misstatement, you are required to understand the internal control, you have to understand accounting policies, you have to check the accounting estimates, you have to decide on use of going concern basis of accounting, whether management's use of going concern basis of accounting is appropriate or not. And if it is a fair presentation framework, you have to evaluate whether the financial statements are giving true and fair view or not. If you have made use of the other auditors' work, then you are responsible to explaining areas. This will have a discussion as a 600. You can ignore this for the time being now. And even you should say that you have some responsibilities to communicate with those charged with governance. What and all matters you have to communicate. This we will discuss in essay 260. In the subsequent revision series, we will understand this. And also you have to communicate key audit matters. And what is the key audit matter? This will discuss in the essay 701. So like this, various items are there which are required to be included in the auditor's responsibility paragraph. Very big paragraph will be there. So much of information, so many responsibilities of the auditor will be explained. But all this is not important. What is important is this point is important. Location of description of auditor's responsibility. Right. Sir, you told all these responsibilities. No, generally the auditor's responsibility paragraph will be very lengthy, where I have to include all that responsibilities of the auditor. What is the location of description of auditor's responsibility? The standard has told you have to include it within the body of the auditor's report. That means within the auditor's report only, keep a paragraph auditor's responsibility and explain all the responsibilities there. This is what in 90% of the cases it will happen. In majority of the cases, this only will happen. So whatever responsibilities of the auditor are there, all that responsibilities, they will include it within the auditor's report only. Like as you could see here, so within the audit report, they have included a paragraph, auditor's responsibilities, and all that responsibilities they have explained here. So you can include it within the body of the auditor's report, or even you can add an appendix to the auditor's report. So what do you mean by appendix? So if you feel that because of this auditor's responsibility paragraph, my report is looking very lengthy and people are not reading important information. So what I can do is I can just give the heading here, auditor's responsibility. I will not write all these responsibilities here. What I will say is I will add it here, refer appendix 1. Refer appendix 1, appendix 2. That means what I will do is this information, this detailed information, I will not include it here. After this audit report, I will add one attachment. I will give a heading, so and so appendix, so and so annex here. There I will explain all the responsibilities. What I will just say here is I will give the heading here, auditor's responsibilities, and I will say refer appendix number 1. I will add one attachment to the audit report where I will explain all that responsibilities. Or what else the standard has given the permission is, if you see here, by a specific reference within the auditor's report to the location of such a description of an website of an appropriate authority where law, regulation or the auditing standards expressly permit the auditor to do so. That means sometimes what will happen is whatever your responsibilities are there, those responsibilities are already mentioned on a website. Your responsibilities are mentioned on some website. If you are permitted by law or regulation, what you can do is instead of writing all your responsibilities here, or instead of adding it in the appendix, what you can say is you can say refer to so and so website. That link you can give, provided if it is permitted by law or regulation. Instead of writing your responsibilities here, if your responsibilities are stated somewhere on a website, that link of the website also you can add it here. Able to understand? From here question might come either in the form of MCQs. So whatever it is, location of description of auditor's responsibility, where it should be either within the body of the auditor's report or as an appendix to the auditor's report, or if permitted by law or regulatory authorities, you can give a reference to the website or description of the website where your responsibilities are mentioned. So this is important. And one more important thing here, see, in case if you are giving disclaimer of opinion, then your auditor's responsibility paragraph will not be this much detailed. If you are giving disclaimer of opinion, we have seen list of lengthy responsibilities, no? All that responsibilities you should not include in your auditor's responsibility paragraph. Your auditor's responsibility paragraph should be very limited. It should contain minimum information. Sir, what is that? So if you see here, when auditor disclaims an opinion on financial statements due to inability to obtain sufficient and appropriate audit evidence, auditor's responsibility paragraph shall include only the following. Phrases are very important. So that's why while drafting this material, I did not do so much of summarization. Why? Because if you don't learn the standard terminology, you will not secure the marks, you will not understand the question. So what this paragraph says is, if you are giving a disclaimer of opinion, then your auditor's responsibility paragraph need not include all the details whatever I have told you just now. Your auditor's responsibility paragraph should only include certain items. Only 3 items must be included in the auditor's responsibility paragraph. What are they? Number 1, a statement that auditor's responsibility is to conduct an audit as per the standards on audit. However, you have to add one statement that because of the matters which I have explained in the basis for disclaimer of opinion, you are unable to obtain audit evidence. You are unable to obtain a opinion. And the statement about auditor's independence and ethical responsibilities. Only these 3 lines should come in my auditor's responsibility paragraph. No need to have a detailed auditor's responsibility paragraph. Only three things must come in my auditor's responsibility paragraph when I am giving a disclaimer of opinion. What are that three things? Number one, that you are required to do the audit as per standards on audit. But however, because of the matters explained in the basis for disclaimer of opinion paragraph, you are unable to perform that procedures, you are unable to obtain the evidence, and you have to include a statement saying that you have to include a statement saying that you are required to be independent and you comply with ethical responsibilities. Just this three information should come in my auditor's responsibility. Rest of all the items are not required to be included. Once again, very important from the examination perspective. So let us go back to the contents once again. So we have understood management responsibility paragraph, we have understood auditor's responsibility paragraph, then we have one more paragraph called reporting on legal and other regulatory requirements. Sir, what do you mean by this? See, we are preparing this audit report as per the standards on audit. Apart from the standards on audit, if there are any other reporting requirements as per governing law, like if I am conducting audit of a company under Companies Act, under 143 of the Companies Act also I have reporting requirements. I have to report on certain matters as per section 143. So where I will include that in the auditor's report, I can use this paragraph, reporting on legal and other regulatory requirements. So this paragraph will be used to fulfill my reporting requirements apart from standards. So that's what the title also says, report on legal and other regulatory requirements. Apart from the standards, if as per some other law or regulation, if you have any reporting responsibilities, you can use this paragraph to report them here. And after including this, finally you have to sign the audit report. Sir, how to sign the audit report? If an individual is appointed as an auditor, the individual will sign the audit report on behalf of his personal name. He will mention his name and sign, he will mention his membership number. If a firm is getting appointed as an auditor, not all partners will sign. One partner will sign on behalf of the entire firm. So he will sign in his personal name. He will also mention the name of the firm. He will mention his membership number, and also he has to mention the firm registration number. All this he has to include. So whatever it is, the audit document this report should be signed. If an individual is appointed in his personal name and mentioning his membership number, if a firm is appointed, a partner will sign on behalf of the entire firm. And he will mention his personal name, he will mention the name of the firm, he will mention his membership number, and he will also mention his firm registration number. So whatever it is, that audit report is required to be signed, and then date of signature, the date on which you are putting that the date on which you are signing the audit report, the date of signature you have to mention, the place of signature you have to mention, generally the city to which that the city at which you are signing that report, that date, that place of signature you have to mention, and UDIN is also required to be generated, and that UDIN is also required to be mentioned below your signature. As we all are aware, without the UDIN, today the auditor's signature is not having any validity. UDIN is also required to be included. Understood? So these are all the contents of the auditor's report as per SA 700, and we have covered in a detailed manner all the contents. Okay, so now if you come back to SA 705, there is some more little discussion I would like to explain in SA 705. Then we will wind up 700, 705. We'll go to 701 and 706. So one important information I have to explain here. Yes, sometimes see one more thing here. Before you want to modify the opinion, before you want to give either qualified, adverse or disclaimer of opinion, first you might be required to communicate the matter with those charged with governance. So if you want to modify your opinion, when I say modifying my opinion, either it could be qualified opinion, disclaimer of opinion, adverse opinion, whatever it is. If I want to modify my opinion, you have to first communicate with those charged with governance, then only you have to modify. They don't say obtaining the permission, just you have to have a word with them and then you can modify. Then this point is important. Consequences of inability to obtain sufficient and appropriate evidence to the management due to management imposed limitation after the auditor has accepted the engagement. That means what will happen is, you are a chartered accountant, the client has approached you, asked you to do the audit. Okay, you accepted the audit, you started doing the audit. But after you have accepted the audit, the management is putting a restriction on you. The management is putting a restriction on you. They are not letting you do your work. Every time they are coming and putting a restriction, because of which you are unable to obtain audit evidence. Because of management imposed limitation, after you have accepted the audit, management is putting a limitation on you, because of which you are unable to obtain audit evidence. Then what you are supposed to do? Very simple steps they will try to say. If you are unable to obtain evidence because of management imposed limitation, they say here, first go and request the management to remove. Sir, you are putting unnecessary limitation on me, because of which I am unable to continue with my work. Please remove the limitation. Go and request. See, if the management removes the limitation, well and good, we will continue with the audit. But when the problem will come, we have went and requested the management to remove the limitation, but the management is not removing it. Then what we should do? If the management refuses, the auditor shall communicate the matter to those charged with governance. Sir, your management is putting a restriction and I have requested them to remove it, but still they are not removing it. So you go and communicate with those charged with governance. And if after communicating with those charged with governance also, still if the limitation is not removed, then you should try to look at alternative audit procedures. Whether can you perform any alternative audit procedures to obtain the evidence, evaluate. If you are unable to perform alternative audit procedures also, so what you have done till now, first you have entered requested the management to remove. If the management did not remove it, then what you should do, you should go and request with those charged with governance. Even if those charged with governance are also not removing it, then you should see whether alternative procedures you can perform. See if alternative procedures also not available. Even by performing alternative procedures also, you are not able to obtain sufficient and appropriate evidence, then what you should do, sir? Then you should determine what is the possible effect. So you are unable to obtain audit evidence, no? Because of that matter of which you are unable to obtain audit evidence, what will be the possible effect? See, if the possible effect is only material but not pervasive, don't take any extreme step, continue the audit, give a modified opinion, give a qualified opinion. So if you are unable to obtain evidence because of management imposed limitation, even you are unable to perform alternative audit procedures, you do one thing, determine what is the possible effect. If the possible effect is only material but not pervasive, what you will do? You will give a qualified opinion, continue the audit and give the qualified opinion. If you feel that if the possible effect of the misstatement is material and pervasive, you are unable to obtain evidence because of which the possible effect is material and also pervasive, and it is not an ordinary limitation, it is a limitation imposed by the management, then standard says first option, withdraw from the engagement. To the extent possible, withdraw from the engagement. In case if withdrawal is not permissible, in some cases withdrawal will not be permissible, in those cases what you should do is you should continue the engagement and give the disclaimer. But wherever possible, you have to withdraw. If the possible effect because of non-availability of audit evidence or due to management imposed limitation is material and also pervasive, to the extent possible, you have to withdraw from the engagement. If a withdrawal is not permissible, then continue the audit and give the disclaimer. Now you will get a doubt, sir, when withdrawal is not permitted. Very important, most ignored aspect. From here MCQs are getting tested. Pay attention here. Sir, when withdrawal is not permitted? See, in case of a listed company, SEBI has given some directives and even there are LODR regulations. Because of SEBI and LODR regulations, in some cases in listed company, you just like that can't withdraw. Sir, when you can't withdraw, say for example, as we all are aware, listed companies will even have quarterly financial statements also. Yes or no? Right. So what they say here is, I'll try to explain it in a simple manner. Say for example, there is one quarter. Okay. Oh shit. So let me explain it here. So say for example, April to March, financial year 24-25. So say for example, April to June, this quarter was completed. Okay. And if you are resigning within 45 days, if you are resigning, you can resign it only after giving the report for this quarter. For this quarter, you will do review engagement, no? So you have to give a report for this quarter, then only you can resign. Then in case if you are resigning after 45 days, from the end of the quarter, if you are resigning, you can do it only after giving the report for this quarter, April to June, and also the next quarter. That means for July to September also, you have to give the report. You just like that can't withdraw. In case, and one more thing they say here, if you have already given review reports of 3 quarters, that means April to June quarter, you have already given a review report. July to September quarter also you have given a review report. October to December quarter also you have given the report. After giving reports for all the 3 quarters, then you want to resign, you can't do it. In that case, you have to give the audit report for the entire year also. Then withdrawal will not be permitted. You have to continue the audit for the entire year and complete the audit. So in these kind of circumstances, withdrawal becomes very difficult. Then in that cases, you can't withdraw. You have to continue the engagement and give a disclaimer of opinion. So very, very important, guys. This is where the questions are going to come from. MCQs, like if you see here, when withdrawal is not permitted, if resigning within 45 days from the end of any of the quarters of the period covered under appointment, auditor must first issue audit or limited review report for that quarter. If you are resigning after 45 days, the auditor must issue reports for that quarter and the next quarter. If review reports are issued for all the 3 quarters, the audit report for the full year must be issued. That means you can't withdraw just like that. You have to complete the audit. Understood? Clear and comfortable, everybody? So these are the important information from SA 705 and 700. And one more thing, one more small paragraph I want to cover from SA 700. After that, we'll go to SA 701 and 706. This one, supplementary information presented along with the financial statements. In case if any extra information is getting presented along with the financial statements, they are adding one more supplementary information which is not required as per applicable financial reporting framework, but to the financial statements they have attached that supplementary information. Sir, then what about your opinion? Will your opinion cover only financial statements, or will your opinion cover supplementary information also? Will your opinion cover only financial statements, or will your opinion cover even supplementary information also? How to decide it? That decision whether my opinion will cover only financial statements or even my opinion will cover supplementary information also or not, it depends on auditor's professional judgment in determining whether that supplementary information is an integral part or not. So whether my opinion will cover will my opinion cover only financial statements, or will my opinion extend to financials, will my opinion will extend to supplementary information also or not, that depends on auditor's professional judgment of whether that supplementary information is an integral part or it is not an integral part. If it was decided that supplementary information is integral part of the financial statements, then it should also be covered by auditor's opinion. If you feel that along with the financial statements they are adding some one more page, say for example they are giving product wise revenue, not required as per applicable financial reporting framework, but management has added that statement. Now you use your professional judgment and determine whether that product wise revenue is it an integral part or not an integral part. If you feel that it is an integral part, even you have to express your opinion on the supplementary information also. If you feel that it is not an integral part, it is not an integral part of the financial statements, then what you should do? Then the auditor should evaluate whether supplementary information is presented in such a way that it is clearly differentiated from the audited financial statements. If you are not giving your opinion on the supplementary information, then you should make sure that it is properly separated. That supplementary information is properly differentiated from the financial statements. Why? Because if it is not properly differentiated, the user might have a notion that even your opinion is on supplementary information also, but you are not giving it no. So that's why you have to make sure that the management has properly differentiated that supplementary information with my financial information. If this is not the case, if the management is not differentiating, if the management is clubbing, then the auditor shall ask the management to change how the unaudited supplementary information is presented. You should ask the management, no sir, I will not agree to it. Please separate it. Or at least give a heading for that information that it is unaudited. You have to ask the management to take that proper care. If the management refuses to do so, if the management is not differentiating, if they are not identifying that it is unaudited, then the auditor shall identify unaudited supplementary information and explain about that in the auditor's report, saying that that information has not been audited. If the management is not bifurcating that, so you include in your audit report, there is some paragraph called other information, not other matter. The auditors generally use one paragraph called supplementary information or other information, like that they will use one extra paragraph. In that paragraph they have to say that your audit report is only on financial information, your opinion has nothing to do with the supplementary information, that you can highlight it in your auditor's report. Understood? Important from the examination perspective. Okay, I think with this we have successfully completed 700 and 705. Now we will try to cover two standards, 701 and 706, which talks about three contents. One is key audit matter and the other one is emphasis of matter and other matter paragraph. Key audit matter paragraph is covered under 701. Emphasis of matter and other matter paragraph is covered under SA 706. So let us try to understand these are two standards. With that 700 thing will come to an end. Then we will discuss reporting requirements under 143 subsection 143 subsection 1, 3, 12 and 11, that we will try to have a understanding. But before that, let us try to complete 701 and 706. We will try to cover it. So we will try to communicate now. We'll try to understand now the contents of SA 701, which is talking about communicating key audit matters in the auditor's report. So now the standard has now there initially we used to have SA 700, 705 and 706. After certain period of time, they have introduced this new standard called SA 701, and this new standard SA 701 asks the auditor to include in their audit report one more content called key audit matters in their auditor's report. So SA 701 requires the auditors to include in their auditor's report one more paragraph with the heading key audit matter paragraph. Sir, but what exactly is a key audit matter? What exactly is a key audit matter? So you are saying in our audit report, we have to include one paragraph called key audit matter paragraph, but what exactly is the meaning of the key audit matter paragraph? So if you look at the definition, the standard has defined key audit matters in such a manner that key audit matters are those matters that in the auditor's professional judgment were of most significance in the audit of the current period financial statements. So while you are doing audit of the current period financial statements, from the current period financial statements, you have to select a few matters which in your professional judgment you feel it as most significant. From the audit of current period financial statements, you have to identify those matters which you feel it as most significant using what? Using your professional judgment. Once again, here there is no hard and fast rule. It is completely depending on the professional judgment of the auditor. So as an auditor, you use your professional judgment, and from the current year's audit, you select a few matters which you feel it as most significant and explain about that matters in the key audit matter paragraph. And one more instruction the standard has given, you have to select those matters, you have to select the key audit matters from those matters which are communicated with those charged with governance. So there are various matters which we will generally communicate with those charged with governance. From those matters, you have to select a key audit matter. Or if I put the same thing in other way around, if you want to communicate something as a key audit matter, first you have to go and communicate that information with those charged with governance. Okay, so we understood what is the meaning of the key audit matter. Now you will get a doubt, sir, what is the purpose of having this key audit matter? What is the purpose of having key audit matter? See, today our audit reports have become very much similar. We have brought a lot of uniformity because of the standards on audit, because of the SA 700, because of SA 700 series. Audit reports are uniform today. You pick up any two audit reports, they all will look similar. If both auditors are giving a same opinion, everything will look same except the name of the company, name of the auditor, date. Apart from this formalities, audit reports are exactly going to look similar. And people in the industry have started complaining that these audit reports are not giving us any value addition. We are not deriving any value addition by reading this auditor's report. So that's why I felt that in order to increase or enhance the communicative value of the auditor's report, to increase the communicative value of the auditor's report, the standard SA 700 told that you provide greater transparency about the audit, how you have performed. So you identify significant areas and how you have dealt with that significant areas, you explain about it by providing greater transparency, and it will overall increase the communicative value. It will overall enhance the communicative value of the auditor's report. So the main purpose of communicating key audit matters is to enhance the communicative value of auditor's report by providing greater transparency. And this is very important here. Communicating key audit matters is not a substitute for three things. The purpose of communicating key audit matter is not a substitute for three things. Very, very important from the examination perspective. Number one, key audit matters. Communicating key audit matters is not a substitute for disclosure, which is required in the financial statements. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph as per SA 570. Communicating key audit matter is not a substitute for three things. Very important. It is not a substitute for disclosure required in the financial statements as per applicable financial reporting framework. Sir, what do you mean by that? Say, for example, I am conducting audit of the client X Limited. The client X Limited, as per the requirements of their applicable financial reporting framework, they are required to give some disclosure in the notes to accounts. They forgot to do it. They did not explain that notes to accounts in the financial statements. Now they came to the auditor and they asked that, sir, we are supposed to give a disclosure in the financial statements as per applicable financial reporting framework, but we forgot to do it. Anyhow, you are including a key audit matter paragraph in your auditor's report. No, in that paragraph, you explain this disclosure. Do you think key audit matter is a substitute for that? Is the key audit matter introduced to include the disclosures which the management has forgot? No. That is what the meaning of the first point. Key audit matter paragraph is not a substitute for those disclosures required in the financial statements which are required to be done by the management. Similarly, key audit matter is not a substitute for modified opinion. Say for example, I am an auditor. I am conducting audit. While conducting the audit, I found a material misstatement. If I found a material misstatement, what should be my course of action? I should have given a modified opinion. Can I say instead of giving modified opinion, I will explain that in the key audit matter paragraph. Do you think it is acceptable? 100% not. So key audit matter is not a substitute for modified opinion. Key audit matter is also not a substitute for material uncertainty related to going concern paragraph. There is some information which is required to be included in the material uncertainty relating to going concern paragraph, which we will see it under SA 570, and the information which is supposed to go to material uncertainty paragraph, that should go to material uncertainty paragraph only, that should not come under key audit matter paragraph. So key audit matter is not a substitute for these three things. Along with that, they also say one more point, key audit matter is not a separate opinion on any of the paragraphs. So in the key audit matter, whatever matters have been explained, auditor is not giving any separate opinion on any of the matters. Just what simply auditor is doing is, what is a significant matter? What is the matter which is significant? So what is the key audit matter? That he will explain. Then why you have selected that as a key audit matter? Because of what reasons you have selected this as most significant? That reasons he will explain. Along with that, he will also explain how he has tackled, how auditor has responded, what actions you have taken. That's all. So what is the key audit matter? Why he has selected it as a key audit matter? How you have dealt with that? That's it. Only these three things he will explain. He will not give any separate opinion on any of the key audit matter. Next, applicability. Sir, is auditor required to communicate key audit matters in all the entities for the time being now? No. For the time being now, no. Audit is not currently. Key audit matters is not applicable for all the companies. Currently, key audit matters are required to be included only while conducting audit of general purpose financial statements, that too of listed entities. So if you are conducting audit of general purpose financial statements, that too of a listed entity, then only you are required to include the key audit matter. Or sometimes your client might not be a listed entity, but it might be required by law or regulation. If there is any requirement from law or regulation, then also we will include the key audit matter. In rest of all the cases, it is up to the auditor's choice. The auditor will use his professional judgment and decide whether communicating key audit matters in one specific case is required. So the auditors may also decide to communicate key audit matters for other entities. That is completely his choice. But in two cases, it's mandatory. When it is mandatory, if you are conducting audit of general purpose financial statements of a listed entity. Number two, if there is any requirement from any law or regulation. In rest of all the cases, that is up to the auditor's choice. And also how you have to present the key audit matter. So you have to present the key audit matter. You have to use a separate heading, key audit matter. So let me show it here. Let me show the key audit matters here. Yeah. So if you see here, if you want to include the key audit matter, first you have to give a separate side heading, key audit matter. Now in that heading, if you want to explain more than one key audit matter, for each key audit matter, separate subheadings you have to give. So one main heading, key audit matter. And in that, if you have multiple matters to communicate, for each of the key audit matter, you need to have a separate subheading. Like as you could see here, this is one key audit matter. This is the second key audit matter for which a separate heading has been given. There is one more key audit matter for which a separate subheading has been given. So like that, subheading has to be given. In addition to that, before communicating the key audit matter, you need to give some introductory information, some introductory language you have to give. This is the introductory language they are talking to. The same language, even you will be able to find it here also. So this introductory language you have to use. This is also important. Why? Because these days, once again, drafting questions are coming. So before you explain key audit matter, this is the introductory language which you have to use. What is that? Key audit matters are those matters that in the auditor's professional judgment were of most significance while conducting audit of the financial statements. And these matters were addressed in the context of audit of financial statements as a whole and in forming auditor's opinion thereon, and auditor does not provide a separate opinion. As it is this information, as it is this paragraph, you have to include it. Okay, sir, sometimes what will happen is I am conducting the audit, but I don't find anything significant from my current period audits. I have conducted audit of the financial statements of the year 24-25. The standard says from the current year audit, I have to identify those matters which I feel it as most significant. Sir, but I am such an auditor, I have did the audit, but I am unable to find anything as most significant. Can I report last year matters as a key audit matter? The answer is no. You can't explain the last year matters. Sir, but I don't have any key audit matters in the current year. Then what I should do? Here the standards is very interesting thing. If it is a listed company or where it is mandatory to disclose key audit matter, in those cases, what they should do is you have to include in your audit report key audit matter paragraph, and there you have to say that there are no key audit matters. There you have to say what? In that you have to mention there are no key audit matters. Very interesting thing they try to say here. So if you don't have any key audit matter, still you have to include the paragraph key audit matter. In that you have to say that there are no key audit matters. So this is how the format is going to be. This is how the presentation is going to be. So this is how you have to state, except for the matter explained in basis for opinion paragraph or material uncertainty relating to going concern, we have determined that there are no key audit matters. This fact you have to mention. Next, sir, how to determine key audit matter? This I have already told you. Whether a matter is a key audit matter or not, that is something which is completely auditor's professional judgment. Whether a matter is a significant matter or not, that is something which is completely auditor's professional judgment. But however, the standard has given some guidance in which kind of areas you can start looking for key audit matters. That guidance they have given. So in which areas I can start looking for key audit matters? If you see here, you can start looking for key audit matters from those areas where there is a high risk of material misstatement. If the risk of, you can start looking for key audit matters in those areas where there is a high risk, or you can start looking for those key audit matters in those areas where there are significant management judgments. There are certain areas where management has made a lot of judgments. In those areas, you can start looking for key audit matters like provisions or going concern or a provision for bad and doubtful debts. In those areas, you can start looking for key audit matters, or the effect on the audit of significant events or transactions. Like if any significant event or transaction has taken place in the current year, like any acquisition has taken place, any merger has taken place, from those areas also you can determine the key audit matters. So these are the three areas from which you can start looking for key audit matters, where there is a high risk of material misstatement, where there is a significant judgment involved, or where there are significant events or transactions. Then coming to the last part of the standard, when it is prohibited for you to communicate the key audit matters. So SA 701 has also listed some circumstances where the auditor is prohibited from communicating key audit matters. So what are the cases where auditor is prohibited from communicating key audit matters? Number one, if you are giving a disclaimer of opinion. If you are giving a disclaimer of opinion, then your audit report should not contain a paragraph key audit matter. When you are giving a disclaimer of opinion, your audit report should not contain any reference to, your audit report should not have anything called key audit matter paragraph. And not just that, even though you are not giving disclaimer of opinion, in other cases, there are some matters which should not be explained as a key audit matter. That means you are not giving disclaimer, you are giving a normal opinion only. But some cases, some matters should not be communicated as key audit matter. So which matters should not be communicated as key audit matter? Number one, if there is a prohibition from law or regulation. If law or regulation prohibits you to disclose such matter, don't disclose that as a key audit matter. Or if the auditor determines that because of the communication, there will be more adverse consequences. You feel that if I explain certain matter as a key audit matter, it will have more negative consequences, then also don't explain that as a key audit matter. Similarly, if the auditor concludes that matter is highly confidential or sensitive, such matters also you should not disclose in the key audit matter paragraph. So summary here is, if you are giving disclaimer, your audit report will not contain a key audit matters only. In other cases, some matters should not be contained in the key audit matter paragraph. Which matters should not be there in the key audit matter? If there is any prohibition from law or regulation, or if the auditor feels that communication will result in possible adverse consequences, or if the auditor concludes that the matter is highly confidential or sensitive for the interest of the company. Understood? So this is what regarding SA 701. Now we have SA 706, emphasis of matter paragraph and other matter paragraph in the auditor's report. SA 706, which is talking about two contents. This we will try to cover it. So if we complete SA 706, all the 700 series of standards will be over. Then we will proceed ahead and try to understand the reporting requirements under the Companies Act. Yeah, I think the stream and all is going good. So we have successfully done 2 hours 45 minutes of the live stream. Yes, it's a very good thing actually. So thank you so much, guys. You're all being live. So still I'm able to see the views here. Yes, it shows that you're all serious about your preparation and all. Thanks a lot. So all these efforts have been just for the sake of your understanding, to help you out in the examinations. So thanks for your active participation once again. Anyhow, let me proceed further. Right. So essay 706 we will try to discuss now, which is talking about two contents. One is emphasis of matter paragraph and the other one is other matter paragraph in the auditor's report. So let us try to understand what is this emphasis of matter paragraph and what is this other matter paragraph. First of all, I will talk about emphasis of matter paragraph. So what is the meaning of the term emphasis? Emphasis means to highlight. What is the meaning of the term emphasis? Emphasis means to highlight. So emphasis of matter paragraph. So what exactly is this emphasis of matter paragraph? So standard says that emphasis of matter paragraph is used to refer to such matter which is already presented or disclosed in the financial statements. The management in the financial statements, they have already presented and disclosed certain information in the financial statements. But as an auditor, you feel that it is fundamental to the user's understanding of the financial statements. The management in the financial statements which they have prepared, they have included, they have already presented or disclosed certain information without their mistake. The management without their mistake, they have already disclosed or presented certain information in the financial statements. But as an auditor, you feel that even though the management has presented or disclosed that information in the financial statements, but still the user might not read it, because we can't expect each and every user to go from the first page to the last page of the financial statements. So I do feel that even though the management has included that information in the financial statements, but still user might not go through it. But that information is very fundamental to users understanding. I want to highlight it somewhere in my auditor's report. You tell me, can I highlight it by giving a modified opinion? No, management will give me a tight slap. Why? Because management without their fault, they have explained. I can't highlight it by giving a modified opinion. How can I give modified? I give modified only when the financial statements are misleading. But in the given case, financial statements are not misleading. Management has clearly presented. Then I can't modify it. Then how can I highlight, sir? What the standard has told is, you do one thing. If you feel that important, if you feel that matter is very fundamental to users understanding, in your audit report, use a paragraph with the heading emphasis of matter paragraph. And in that paragraph, you highlight that information, whatever you want to bring it to the shareholders' attention. Sir, now you will get it out. Sir, what are the examples, sir? Can you give me a few examples where I might feel that even though the management has disclosed that information in the financial statements, but still it is fundamental to users' understanding? The examples of matters are something like this. Like for example, if you see here, if there is any uncertainty relating to future outcome, like the company is going through one litigation, one case is going on, the management without their mistake, they have clearly explained that as a contingent liability in the notes to accounts. But I felt that the user might not read it. I want to highlight it. I can highlight it in the emphasis of matter paragraph. Or subsequent event, management has adjusted one subsequent event. They did not hide anything. That information they have clearly explained in notes to accounts. So and so subsequent event has taken place. This is adjusting, these adjustments we have done. But I felt that the user might not read it. I want to highlight it somewhere in my auditor's report. Use an emphasis of matter. Or early application of a new accounting standard. Your client has made an early application of a new accounting standard. They have explained it in the notes to accounts, but you want to bring it to the user's attention because it is very much fundamental to his understanding. Highlighted in the emphasis of matter, or even a major catastrophe or calamity also, you can highlight it in the emphasis of matter. So if you see here, usage, when you can include emphasis of matter paragraph. The auditor shall include emphasis of matter paragraph only when he is not required to modify opinion in respect of such matter. So say for example, there is one item of the financial statements. In the financial statements, there is one item which is modified, which is materially misstated. Sorry. There is one item in the financial statements which is materially misstated. You tell me if such item contains a material misstatement, instead of giving modified opinion, can I just highlight it in the emphasis of matter paragraph? Absolutely not. Why? Because if any item is materially misstated, the correct option is not just highlighting, the correct option is giving a modified opinion. So you can include only such items in the emphasis of matter paragraph which are not required, because of which you are not required to give a modified. That means if an item is materially misstated, you can't highlight that information in the emphasis. The correct action is you have to give a modified opinion. And the matter has not been determined to be a key audit matter. Which means if a matter is already determined to be a key audit matter, that will go to key audit matter paragraph, that should not come in the emphasis of matter paragraph. So you can highlight such matter in the emphasis of matter paragraph if because of it you are not required to modify the opinion, and if that has not been determined as a key audit matter. Why? Because if it has already been determined as a key audit matter, that will be explained in the key audit matter, that will not come under emphasis once again. Sir, okay, I have determined some matter which is very much fundamental to users understanding. how I have to present it, sir? So how you have to present it is, if you include the paragraph within a separate section of the auditor's report. So you have to include in your audit report a separate heading, emphasis of matter paragraph, like that one heading you have to use it. Let me see whether it is there here. Right. So I think it's not there in the auditor's report. So whatever it is, but anyhow, I will give you, yeah, here it is. So I see here. So you have to include a separate heading, emphasis of matter paragraph. Then what else? Include in a paragraph a clear reference to the matter being emphasized and to where relevant disclosures that fully describe the matter can be found. So in that emphasis of matter paragraph, you have to explain that reference. You have to give reference. As I have told, in the emphasis of matter paragraph, only that information which is already presented will be highlighted now. So you have to give a reference in that emphasis of matter paragraph where the user can go and find that detailed information. Like as you could see here, if you look at this starting phrase, we draw your attention to note number 32A. The auditor has given reference to the place in the financial statements where the user can go and read it in a detailed manner. So that reference must be there. And few more things here. You should mention that auditor's opinion is not modified. Even you have to add a line that we are not modifying our opinion. We are just highlighting this information to you. So like this is how you are supposed to present. And here also they say the same three things. Whatever three matters for which key audit matter is not a substitute, even emphasis of matter paragraph is also not a substitute for the same three things. What are the three things which it is not a substitute for? It is not a substitute for disclosure in the financial statements. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph as per SA 570. Same, whatever we have discussed in the key audit matter as it is. This is not substitute. Even emphasis of matter paragraph is also not a substitute for that. Understood? So this is what regarding emphasis of matter. Now let us come to the next part, which is other matter paragraph. Sir, what is other matter paragraph? I told that emphasis of matter paragraph is used to highlight that information which is already present or disclosed in the financial statements. They say that other matter paragraph, in the other matter paragraph, we highlight that information which is not presented or disclosed in the financial statements. In the other matter paragraph, we highlight such information which is not presented or disclosed. Which means simply, if I have to put it in very simple sense, in the other matter paragraph, we talk about our responsibilities. Any additional responsibility we have taken, any reduction in our responsibilities. Like for example, there is a joint auditor along with me. I want to explain it. And the principal auditor, there is a branch auditor separately who has conducted the audit of the branch. This you want to explain here. Explain it in the other matter paragraph. You have conducted audit of only current year. Last year you are not the person who did the audit. You want to explain that. Explain it in the other matter paragraph. So mainly we use other matter paragraph for responsibility related matters. So that's what they say here. It is a paragraph which is included in the auditor's report that refer to a matter other than those presented or disclosed in the financial statements. Why? Because if a matter is already presented or disclosed in the financial statements, that we will do it in the emphasis. If something is not presented or disclosed in the financial statements, for that we use other matter paragraph. And mainly we use it, it is relevant to users understanding of audit, auditor's responsibilities or auditor's report. As I've told, mainly we bring the matters relating to auditor's responsibilities. And here also, when you can use other matter paragraph, number one, it should not have been prohibited by law or regulation. Number two, if it has not been determined as a key audit matter. The same thing, whatever they have told for emphasis, the same thing they are saying it here also. And if you want to include the other matter paragraph, like the way we have done it for emphasis of matter paragraph, even the other matter paragraph also, you have to do it under a separate heading. You have to add a separate heading, other matter paragraph. In that you have to highlight the information. Next. And if you want to highlight, if you want to include emphasis of matter paragraph or other matter paragraph in the auditor's report, first you have to communicate with those charged with governance that you are going to use emphasis of matter paragraph or other matter paragraph. And even wording of that paragraph also you have to explain it. Okay, clear and comfortable everybody? So with this we have completed the 4 standards. 4700 series of the standards we have completed. Now the next thing which we have to address is responsibilities. So auditors responsibilities under companies act. We have various reporting requirements under 143 subsection 1, 3, 11, 12, all that we have. So that reporting requirements we have to cover it now. But I think since we have done 3 hours of continuous stream, 2 minutes of break will be appropriate. Okay, so we'll take 2 minutes of break. Just 2 minutes of the break we will take. After 2 minutes of the break, we will resume our discussion regarding reporting responsibilities. Okay, so just 2 minutes break we will take. I will write it here. Don't go anywhere. Just sit at your places. Just stretch out, have some water and sit back at your places. I'm not going anywhere. I will just be back in 2 minutes. So just 2 minutes of break. The stream will continue. Just after 2 minutes, I will come back. Okay. Okay, guys, so let us resume our discussion. So I think we are left with 1 more hour for today for revision. So I might extend if required. So why? Because I have to complete this. We will try to do this audit reporting chapter. Today we'll try to wind it up. So that tomorrow we can start afresh with the subsequent chapters. So now, since we have successfully completed the reporting requirements as per the standards on audit, now we have few reporting requirements under few sections of the Companies Act. So we have reporting requirements under 143 subsection 1, we have reporting requirements under 143 subsection 3, we have reporting requirements under 143 subsection 11, and we have reporting requirements under 143 subsection 12. Out of all that, the reporting requirements under 143 subsection 11, which we also give it a name called CARO 2020. So the reporting requirements under 143 subsection 12, subsection 11, CARO 2020 is very important. Without a question from the CARO, there will not be a question paper. Compulsory question will be there from CARO 2020. So apart from that, we have reporting requirements from 143 subsection 1, subsection 3, subsection 12. Let us try to quickly cover it. Not that important from the examination perspective. Just a few points here and there will be there. We'll try to quickly cover them. So first one, reporting requirements under 143 subsection 1. There are 6 matters which the auditor is required to inquire. Sometimes even they might ask a question, what are the matters which auditor is required to inquire, also they can say. So matters to inquire or matters to be reported under 143 subsection 1, 6 matters we have. Quickly we will try to do it, guys. Not that important from the examination perspective. Quickly we will try to wind it up. Number one, first one, whether loans and advances made by the company. You have to check whatever loans and advances which are given by the company to the others. If they are on the basis of security, I need to check whether they are properly secured or not. And also I need to observe the terms and conditions on which that loans are given. Are they prejudicial? Are they harmful to the interest of the company or its members? This is the first point. So I need to verify loans and advances made by the company. If they are on the basis of security, properly secured, the terms and conditions on which they are made, are they prejudicial? Are they harmful to the interest of the company? Second point, I need to check the transactions which are represented merely by book entries, whether there are any transactions represented merely by book entries. If yes, are they prejudicial? Are they harmful to the interest of the company? Third one, I need to check whether the company is having assets in the form of shares, debentures and other securities, and have they sold any of their shares, debentures and other securities for a price less than the purchase price. Basically, I need to check whether my client is holding any financial assets, whether my client is holding any financial instruments, and whether they have sold any of that financial instruments at a loss less than purchase price. However, this point is not required to be reported if I am conducting audit of such a client which is an investment company or banking company. So this point is not required to be reported in the audit of an investment company or a banking company. Fourth point, whether personal expenses have been charged to revenue account, whether the client is showing any personal expenses to revenue account. That means personal expenses shown as business expenses, report on it. Sorry, there is fifth point. Fourth point is whether loans and advances have been shown as deposits. The client has given loans and advances, but instead of showing it as loans and advances, are they showing it as deposits? Then last point, whether it was stated in the books of accounts that the company has allotted shares for cash. If anywhere it was stated in the books of accounts that the company has allocated the shares for cash. If yes, whether cash has actually been received. If cash is not received, whether the position stated in the financial statements is correct, regular and not misleading. That's all. These are the 6 points which are required to be reported under 143 subsection 1, and you are required to report these points only when you have a negative remark. Only when you have a negative remark you are required to report it. If you have a positive comment, you are not required to report any of the matters. Then there are certain matters which are required to be reported under 143 subsection 3. Here there are plenty of matters are there, and but out of all that, the matters under clause J, 143 subsection 3 clause J, these matters are important. They have a chance of asking the question in the examination. But anyhow, all other classes also quickly we will go through. So what are the matters which are required to be reported under 143 subsection 3? Clause A says that whether you have sought and obtained all the information and explanation necessary. Did you get all the information and explanation necessary for the purpose of your audit? And if you have not received any information, what is that effect of such information which you have not received? Number 2, whether in your opinion proper books of accounts as required by the law have been kept, and have you received proper returns from the branches or not? Number 3, in case if you are a principal auditor, you are not the branch auditor, branch office accounts are audited by separate branch auditor. Did that branch auditor send his report to you? Have you considered that report? How you have dealt with that report while giving the opinion on the entire company? So receipt of the branch audit report. Fourth one, whether the company's balance sheet and P&L are matching with the books of accounts and returns. Nothing but financial statements should be matching with the books of accounts. Then whether in his opinion the financial statements comply with accounting standards. Then clause F, do you have any observations? Do you have any comments on the financial transactions or matters which have an adverse effect on the functioning of the company? So do you find any transaction? Do you have any observation where the company has done some financial transaction which is having an adverse effect, which is having a bad effect on the functioning of the company? Then you have to comment whether any of the director is disqualified under 164 subsection 2. And as we all know, a director will become disqualified under 164 subsection 2 where the company has not filed annual return or financial statements for 3 consecutive years. If the company did not file the annual return or financial statements, all the directors will be disqualified for a duration of 5 years. I need to check whether any director of my company has been disqualified under 164 subsection 2. Next one, any qualification, reservation or adverse remark relating to maintenance of accounts and other matters. Did you have any qualification? Did you have any reservation? Do you have any adverse remark relating to maintenance of books of accounts? Do you have any negative remark regarding books of accounts? Comment on it. Then clause I, important, you need to comment whether your client is having adequate internal financial controls and also whether those internal controls are operating effectively or not. So very important, 143 subsection 3 clause I, shortcut to remember, 143 subsection 3 clause I stands for internal financial controls. So I need to comment whether my client is having proper internal financial controls and not just that whether they are operating effectively or not. But however, some companies are exempted from the requirements of internal financial controls. Which companies are exempted from internal financial controls? So it may be noted that reporting requirements on adequacy of internal financial controls will not be applicable. For whom? To a private company, which is either a one-person company or a small company, and also which has a turnover of less than 50 crores as per the latest audited financial statements, and aggregate borrowings from banks or financial institutions or any body corporate at any point of time during financial year less than 25 crores. So these are private companies. It should be either one-person company or small company, or it should fulfill any 2 conditions, not any 2, both conditions. Number 1, turnover should be less than 50 crores and its borrowings from banks and financial institutions or any body corporate at any point of time should be less than 25 crores. If these conditions are satisfied by a private company, then they are not required to implement internal financial controls. If the client is exempted from internal financial controls, you will also say you are also not required to report under 143 subsection 3 clause I. So till here, okay. Now comes the important part. There are various matters which are required to be reported under 143 subsection 3 clause J. There are additional matters which are required to be reported. What are they? Number 1. So 6 matters we have here. Listen carefully. Number 1, you need to comment whether the company has disclosed the impact of pending litigations. If the company is going through any pending litigation, whether company has disclosed impact of all that pending litigations in the financial statements or not, that I need to give a comment. So they are not asking auditor to disclose the impact of pending litigations. They are asking auditor to check whether the company has given the impact of, whether company has disclosed in their financial statements the impact of pending litigations. Number 2, I need to check whether company has made a provision for material foreseeable losses, if any, on long-term contracts, including derivative contracts. So if the client has entered into any long-term contract and they know that on this long-term contract they are going to make a loss, they should create a provision, including on derivative contracts. So I need to check whether my client has made a provision for material foreseeable losses on the long-term contracts, including derivative contracts. Then third one, I need to check whether my client is required to transfer any funds to Investor Education and Protection Fund. If yes, have they made any delay in transferring the amounts which are required to be transferred to the IEPF? Next, fourth point, I will have a detailed discussion. Important. So fifth and sixth will try to understand. Fifth one, whether the dividend declared by the company is in compliance with section 123 of the Companies Act. Whether your client company has declared dividend, if yes, they can't declare the dividend, they can't declare so much amount of dividend in whatever manner they want. So whatever dividend they are declaring, that must be in compliance with section 123 of the Companies Act. I need to check the compliance. Similarly, I need to check that whether the client is maintaining such an accounting software which is having a feature of recording audit trail facility. So I need to check my client is using such an accounting software which is having a facility of recording audit trail, and also I need to check that audit trail has been operated throughout the year for all the transactions, and that audit trail feature has not been tampered. That information of the audit trail should not have been tampered with, and it should be preserved by the company as per statutory records, statutory requirements. So three things I need to check. First of all, whether my client is using such an accounting software which is having audit trail. Number two, that audit trail should not be tampered with. The audit trail should be operated throughout the year, and that audit trail should be preserved. Clear? Next, now comes the fourth point. Here there are some important details which I will try to explain. So in the fourth point, they say three subpoints. First subpoint, they say that you need to ask the management a written confirmation. You need to ask the management of your client in a written confirmation that they did not indulge in certain transactions without disclosing it in the notes to accounts. Under the fourth point, the first subpoints, I will try to explain it later on. You can read it. In that first subpoint says the auditor should obtain written confirmation from the management that they did not indulge in certain transactions without disclosing it in the notes to accounts. So what transaction they should not have indulged in? Say for example, your client company is there. Okay. So your client company has given some loan, advance, or they have made investment in another entity, which we call them as intermediary. Your client has given some loan, advance, or investment to an intermediary with an understanding between your client company and the intermediate company. There is an understanding. That understanding could be in written format, or that understanding could be otherwise also. So what is that understanding is, this intermediary should go and give the amount of loan, or they go and give an advance, or either they give a security or guarantee on behalf of some ultimate beneficiary. They have to go and give some loan, advance, or security on behalf of ultimate beneficiary. This is a transaction without disclosing in the notes to accounts. Company should not have done it. Ask the management to give a written confirmation that they did not do this kind of transaction. Which kind of transaction? My client company is giving some loan or advance or making an investment in some intermediary with an understanding that this intermediary should go and give the amount as loan, advance, or act as guarantor on behalf of ultimate beneficiary. This transaction, the company should not have done it without disclosing in the notes to accounts. Ask the management to give a written confirmation. See, if you understand the substance here, what is happening is, client company wants to do some favor to ultimate beneficiary. Either they are prohibited from doing it, or if they do it, they become answerable. So to avoid it, what they are doing, they are creating an intermediary. Should they do it or should they not do it? They should not do it. So that only we are asking the management to give a confirmation that they did not do this kind of transaction. Okay, next, second point. In the second point, in the fourth subpoint 2, they say one more thing here. You need to obtain written representation. You need to obtain written confirmation from the management of the company that they did not involve in certain transactions without disclosing it in the notes to accounts. Which kind of transactions? Like say for example, there is a client company. Your client company is there. Your client company has received some funds either in the form of loan, advance, or investment from some another entity, which we call them as funding party. So your client company has received, we are talking from the perspective of client company. So your client company has received some loan, advance, or investments from a funding party with an understanding. Now funding party and my client company both are having an understanding. So what is that understanding? That my client company, whatever loan, advance, or investment they have received, they have to go and give that amount as loan or advance, or either provide security on behalf of ultimate beneficiary. Should my client, see here in the previous case, my client created an intermediary to do a favor to ultimate beneficiary. But in the second case, my client itself is acting as a intermediary. So you tell me, funding party wants to do some favor to ultimate beneficiary, but to avoid that, they are using my client company as a vehicle, as an intermediary. Should my client company do such kind of transactions? No, they should not do that kind of transactions. Ask the management that they have not done this transaction. Ask them to give a written confirmation. Okay. So 2 written confirmations you have to get. You should ask the client company to give a written confirmation that they did not create an intermediary to do a favor to ultimate beneficiary. They should also ask the management to give a written confirmation that my client company did not act as intermediary for facilitating a fraudulent transaction. So ask the management to give this 2 written confirmation. And the third sub point says that if you ask the management will give written confirmation. They will say that, yes, sir, we did not do any of these transactions. But will you blindly believe it? No, we should not blindly believe it. We should perform some procedures as we feel suitable and check whatever confirmation management has given under the previous two cases. Are they correct or are they misleading? Able to understand, everyone? So two written confirmations we will obtain, and in the third point they say management will give written confirmation. No one will voluntarily come and say they have done the mistakes, but don't blindly believe it. Perform some appropriate procedures and find out whether those written confirmations which you got from the management, are they appropriate or are they wrong statements. Clear? So these are the few reporting requirements under 143 subsection 3 clause J, having a high chance of getting tested in the examination. Then we have reporting requirements under 143 subsection 12. We'll cover 143 subsection 12. Then we will try to understand 143 subsection 11. Sir, what are reporting requirements under 143 subsection 12? Reporting requirements under 143 subsection 12, that we also call it as fraud reporting. That we also call it as what? Fraud reporting. So as an auditor, as a part of your responsibility of conducting audit of a company, if you have reason to believe that a fraud has taken place, then you have some reporting requirements to fulfill. And in order to fulfill that reporting requirements, we divide the frauds into two categories: the fraud in which the amount involved is 1 crore or more, the fraud in which the amount involved is less than a crore. If the amount involved in the fraud is 1 crore or more, you are required to report that matter to the central government. If the amount involved in the fraud is less than 1 crore, no central government reporting. You are not required to report to the central government. So let us try to understand what is the manner of reporting if the amount involved is 1 crore or more, and what will be the manner of reporting if the amount involved is less than a crore. So if the amount involved is 1 crore or more, then you are required to report to the central government, and the manner of reporting is, first, within 2 days, you are required to report the matter to the audit committee. If audit committee is there, to the audit committee you report. If there is no audit committee, then only to the board of directors. So here most of the students often come under a misconception. They have a notion that auditor will have an option to either report the matter to audit committee or board of directors. No. If audit committee is there, report to the audit committee only. If audit committee is not there, then report to the board of directors. So whatever it is, auditor first communicate the matter within 2 days to the audit committee or board of directors if there is no audit committee, and give them 45 days of time. And give them 45 days of time to seek their reply or observations. If reply is received within 45 days, then you need to report the matter to the central government within 15 days of reply. Within 15 days of reply, the auditor is required to report the matter to the central government. And what and all you have to communicate? You have to communicate the report which you have sent to board of directors or audit committee. On that, what replies you have received. On that reply, what are your comments or observations. So everything you have to communicate. And all this reporting should happen in form number ADT 4. In form number ADT 4, you have to communicate. And this reporting should take place on letterhead of the auditor. And that letterhead should contain all the details of the auditor, like the name of his firm, his address, his mobile number, his email address. It should contain the seal of the auditor. It should contain the signature of the auditor. And when I say you have to report the matter to the central government, the information, this ADT 4 will be reported to Secretary, Ministry of Corporate Affairs. Clear? So within 45 days, if you receive reply, within 15 days of receiving the reply, you have to report the matter to central government. And what and all you are required to report? A report which I have originally sent to board of directors or audit committee. On that, what reply you have received? On that reply, what are your comments? And all this reporting requirement should take place in form number ADT 4 on the letterhead of the auditor, containing all the details of the auditor. Then, sir, what if the reply is not received? If I did not receive reply, then what will happen? Even if the reply is not received, then also you are required to report to the central government. And what and all you will report here? You will report the matter which has been sent to audit committee or board of directors, along with the fact that reply has not been received. Here also reporting requirements will happen in form number ADT 4. Here also the reporting requirement will take place on the letterhead of the auditor, and it should also contain seal and all. Everything will be there. Understood? So these are the reporting requirements under, in case if the amount involved in the fraud is 1 crore or more. So if you see here, if the reply is not received, they did not mention the time limit. Here they told within 15 days of receiving the reply, you have to communicate. In case if the reply is not received, they did not mention the time limit here specifically, but there is an implied time limit here. You can derive the time limit from the other case. So what you will generally do is, you will give the management 45 days of time to reply. If you did not get that reply within 45 days, within 15 days from the expiry of the 45 days, you are required to communicate the matter to the central government. So there is no express time limit, but this time limit is implied from the other case. Next, sir, what if the amount involved in the fraud is less than 1 crore? Here also they say you are required to report the matter to audit committee or board of directors. How many days, sir? Within 2 days of the knowledge of the fraud, you are required to report it. And within 2 days of the knowledge, you have to communicate. And what and all you are required to communicate? Nature of the fraud along with the description. What is the approximate amount involved and who are the parties involved? Who are the parties involved? These are 3 things you have to communicate to audit committee if it is there. If audit committee is not there, to the board of directors. That's all. Your responsibility will come to an end. There is no requirement to report this matter to the central government. But however, after you have fulfilled your reporting requirements, now the board of directors, they will give something called a board's report. In the board's report, they have to disclose some information like what is the nature of the fraud along with the description, what is the approximate amount involved, who are the parties involved, along with what remedial actions are taken. These 4 points are required to be highlighted in the board's report, not in the any other report. The auditor's responsibility will come to an end once you communicate nature of the fraud, approximate amount involved, parties involved. But finally, when the board will give board's report, in that board's report, they will explain these 3 things along with the remedial actions taken. And whatever reporting requirements we have seen here, all that reporting requirements will be applicable for company secretary, even cost auditor doing the cost audit. In case if you fail to comply with that reporting requirements, you have to face the penalties. Clear? So this is what reporting requirement under 143 subsection 12. Now we come to the most important part, reporting requirements under 143 subsection 11, CARO. 143 subsection 11, CARO reporting requirements. We will try to see it now. Okay, right. So let us try to have a look at it. CARO reporting requirements. We have a total of 20 matters which are required to be reported. 21 actually. The 21st point will come in the audit of consolidated financial statements. So, but first let us look at the matters which are required to be reported. See, before we can talk about what are that 20 or 21 matters which are required to be reported, first let us try to understand applicability. So first we have to understand applicability. Sir, does auditor of each and every company is required to report on CARO? First, initially they have told yes, auditors of every company is required to report on CARO, but later they have given relaxation to few companies. So first let us concentrate on the applicability. Not that important from the CA final perspective. At the CA inter level, they ask so many questions from applicability. At the CA final, they ask questions less on applicability, more on the reporting requirements, but we don't know what will be the mindset of the ICA at any point of time. At the CA final level also, they might think of asking the applicability. So just on a precautionary measure, we will try to understand. Sir, they told that this CARO reporting requirements will apply to every company, including a foreign company. However, it shall not apply for certain companies. So to whom it shall not apply? For a banking company, CARO is not applicable. For an insurance company, CARO is not applicable. For a Section 8 company, CARO is not applicable. For a one-person company, CARO is not applicable. For a small company, CARO is not applicable. And a private limited company, if it satisfies all 4 conditions. Not anyone. If a private limited, it should not be a private unlimited company. It should be a private limited company, and it must fulfill 4 conditions for CARO to be not applicable. That means if a private limited company has violated even one of the below mentioned conditions also, then CARO will become applicable. So for a private limited company, the CARO to be not applicable, we need to, that private limited company should fulfill 4 conditions. All 4 conditions they have to comply. Sir, what are that 4 conditions they have to comply? Number 1, it should not be a subsidiary or holding of a public company. That means if your client is a private limited company, its holding company should not be a public company, its a subsidiary company should not be a public company. So neither the holding company nor the subsidiary company should be a public company. Condition number 1. Number 2, the total paid up capital and reserves and surpluses should be less than or equal to 1 crore as on the balance sheet date. So as on 31st of March, as on the balance sheet date, the total of paid up capital along with the reserves and surpluses shall be less than or equal to 1 crore. It should not exceed 1 crore. When we have to check this condition, we have to check this condition only as on the balance sheet date. And the total borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Third condition, borrowings. Not all borrowings. You have to consider only borrowings from banks and financial institutions, and they should not exceed 1 crore, not just on the balance sheet date, at any point of time during the financial year. So at any point of time during the financial year, if the borrowing has exceeded 1 crore, CARO will become applicable, not just on the balance sheet date. So here you have to be very careful. For paid up capital and reserves and surpluses, they are asking us to check the condition of not exceeding 1 crore only as on the balance sheet date. But when it comes to borrowings from banks and financial institutions, they are asking us to check whether it has not exceeded 1 crore at any point of time during the financial year. Like say for example, financial year 24-25, as on 1st of April, the opening balance of the borrowings from banks and financial institutions is 70. During the year, they have obtained additional borrowings as on 30th of June, they have obtained additional borrowings of 40 lakh rupees. But during the year, 30th of September, they repaid some 20 lakhs worth of borrowings. So as on the balance sheet date, as on 31st of March, the closing balance is 90 lakh rupees. Will CARO become applicable? Yes. Sir, closing balance is less than 1 crore? No, doesn't matter. Why? Because for some point of time, the borrowing has exceeded 1 crore rupees, CARO will become applicable. And the last condition, the total turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crores during the financial year. So when a private limited company has satisfied all these 4 conditions, then CARO will not become applicable to it. So what are the 4 conditions? Number 1, not being a subsidiary or holding of a public company. Number 2, the paid up capital and reserves and surpluses shall not exceed 1 crore as on the balance sheet date. The total of borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. The turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crores during the financial year. Clear? So this is what regarding applicability. And few more things which you have to keep in mind. So in case if you are calculating the limits, in case if you are checking the applicability, in case of a company which is having branches, company is having head office plus branches, these limits you have to calculate for the company as a whole, not for head office separately and branch separately. The limit has to be calculated for the company as a whole. And once for company as a whole, CARO becomes applicable, all the principal auditor, all the branch auditor, everybody has to report on the CARO. Next, see, if you take holding companies, they will prepare 2 sets of financial statements, standalone financial statement, consolidated financial statements. For both, audit will happen. There will be an audit report on standalone financial statements. There will be audit report on consolidated financial statements. First, talking about limits calculation. Limits are required to be calculated on the basis of standalone financial statements, not on the basis of consolidated financial statements. And one more thing here, the CARO, the auditors are required to report on CARO only on standalone financial statements. The CARO is generally exempted for audit of consolidated financial statements except one clause. Only one clause they are required to comment in the case of audit of consolidated financial statements, which is clause number 21. So only one clause is required to be reported in the case of audit of consolidated financial statements. All other clauses are exempted. Clear? So these are the few points which you have to keep in mind regarding applicability. Now comes the clauses. Sir, what and all are the different clauses which are required to be reported? What and all are the different matters which are required to be reported? As I have told, total 21 matters are there which are required to be reported. Let us try to address each and every point in a detailed manner. And as I am saying, without a question from CARO, we are not seeing a question paper these days. Very, very important, easy scoring actually. So what are the clauses to be reported? Number 1, first clause is regarding property, plant and equipment. So when I say property, plant and equipment, here they are talking about tangible, intangible, everything. They are collectively combined it under property, plant and equipment. So let us see what are the matters which are required to be communicated, which are required to be verified by the auditor regarding PPE. Number 1, first I need to check whether the client is maintaining proper records. They are not asking auditor to maintain the records. They are only asking the auditor to check whether company is maintaining proper records. And in that records, from that records, you should be able to know quantitative details of the PPE and intangible assets and also their situation. So quantitative details and the location of the PPE, we should know. So whether the company is maintaining such records regarding PPE or not, I have to check. Number 2, physical verification. They are not asking auditor to do physical verification. They are just asking auditor to check whether management has physically verified the assets. Physically verified fixed assets at reasonable interval. Sir, what is reasonable interval? Once in every 3 years. Need not be every year. Once in 3 years, they should have done the physical verification. This they have told it as per the guidance note on CARO. So whatever it is, the auditor should verify whether management has done physical verification of fixed assets, that too at reasonable intervals. Okay. Reasonable intervals is once in every 3 years. Next, whether any discrepancies on that verification whether any discrepancy has been found out. What do you mean by discrepancy? Between the stock, between the assets lying physically and the assets as per books, is there any discrepancy is there? And whether that discrepancy has been properly dealt with in the books of accounts. So that is the second point. You need to check whether management has done the physical verification and at reasonable intervals on that verification, whether any discrepancy has been found out. If yes, whether it has been properly dealt with in the books of accounts. Third point, we need to check the title of the immobile properties. So when I say immobile properties, land and buildings will come here. So I need to check whatever immobile properties are there, which are shown in the balance sheet, whether the title of the immobile properties is in the name of the company. Sir, how will I get to know title is in the name of the company or not? Get that sale deeds and ownership deeds. So you need to check whether in the sale deeds the name of the company is there or not. If not, if you find that there are certain immobile properties which are not held in the name of the company, then you need to give some extra details. You need to report some extra details. What details I have to report? Number one, description of the property. What is its gross carrying value? Held in whose name? If it is not in the name of the company, then in whose name it is there? Whether that person in whose name the property is there, is he a promoter, director or employee? For how much duration the company is holding that asset, and the reason why that is not in the name of the company. Why it is not transferred in the name of the company? What is the reason for that? Clear? That is the third point. So 3 points we have seen regarding PPE. What are they? Number one, whether the client is maintaining proper records. Number two, whether physical verification has been done. Number three, title of the immobile properties is held in the name of the company. Number four, I need to check whether the company has done the revaluation of its PPE or intangible assets or both during the year. If yes, I need to check that revaluation has been done on the basis of valuation done by a registered valuer. That revaluation should have been done by registered valuer. It should not, revaluation should not be done on the basis of whatever comes to the management's mind. I need to check that revaluation has been done after getting the valuation certificate from the registered valuer. And also I need to specify the amount of change before revaluation, after revaluation, what is the amount of the change I have to report, but only when change is a 10% or more in the aggregate of net carrying value of each class of PPE or intangible asset. Change you are required to mention only when before and after revaluation the change is a 10% or more, that too in the net carrying value of aggregate of each property, plant and equipment, class of property, plant and equipment. Here often students will get confused. Say for example, buildings is there, buildings class of PPE is there. In that 3 buildings we have building 1, building 2, building 3. Building 1 before revaluation, after revaluation values are there. So building 1 some value, building 2 some value. So before revaluation, after revaluation some values are there. Now when I talk about the change, building 1 has been revaluated by more than 10%. And for building 2 the change is 4%. The building 3 has been revaluated by minus 6%. Now people will feel that since the change in the value, since the amount of change is more than 5% here and here, building 1 and building 2 amount I am required to mention. No, this is not how you need to check. How you need to check is, you need to check the value, aggregate value of each class. For the entire building class, what is the value before revaluation? What is the value after revaluation? Here you need to calculate the change. For example, for the entire class before and after revaluation, the change is only 3%. Then nothing is required to be reported. Then nothing, no amount is required to be reported. So you need to specify the amount of change only when the change is a 10% or more in the aggregate of net carrying value of each class of property, plant and equipment or intangible assets. I think I might have done a mistake here. 60. Let us take this 60. So you might come to a wrong conclusion that building 1 and building 3 amount is required to be reported. No, only when the entire class, for the entire class, if the change is 10% or more, then only report the amount, right? So 4 points regarding PPE. Number 1, maintenance of records. Number 2, physical verification at reasonable intervals. Number 3, title of the immobile properties is held in the name of the company. Number 4, revaluation. Number 5, Binami transactions. Whether any proceedings either have been started or already started in the past and are pending against the company for holding any Binami properties under Binami Transactions Prohibition Act. If yes, whether company has appropriately disclosed the details in its financial statements. They are not asking auditor to disclose the Binami cases. They are asking the auditor to check whether company has disclosed the transactions of Binami actions in their financial statements. If any case has been initiated or if any case is pending for holding any Binami properties, whether the company has disclosed the details of that pending litigations in their financial statements or not, that I have to comment. They are not asking auditor to give the details of that Binami transactions in his auditor's report. Clear? So first point is PP. Regarding PP, 5 points we have: maintenance of records, physical verification, title of the immovable properties, revaluation, and holding of Binami transactions. Next one. The second clause which is required to be reported is relating to inventory. Second matter which is required to be reported is relating to inventory. So regarding inventory, what I need to check? Let us see. Physical verification. Here also I need to check whether physical verification of inventory has been conducted at reasonable interval, not by the auditor. I need to check whether inventory physical verification has been done by the management at reasonable intervals. For the purpose of inventory, reasonable interval means once in every year. Once in a year, they have to do the physical verification of inventory. When it comes to PPE, once in 3 years, but when it comes to inventory, once in a year, they have to do the physical verification. Number one, if yes, whether we need to check, we need to comment whether management has done physical verification of inventory. If yes, whether coverage and procedures of such verification are appropriate. Did the management do the physical verification in a proper manner? Have they covered as per the size of the inventory? And what procedures they have followed for physical verification? Are they matching with the size of the company? That I have to give a comment. If I have to put it in simple terms, whether the management did the physical verification in a proper manner or not, I have to give a comment. Number two, on doing that physical verification, did you find any discrepancy of how much 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt? Here also, if you find any discrepancy, you need to report, but only when the discrepancy is a 10% or more. Not for each item of inventory, for each class of inventory. Like we have raw material, work in progress, finished goods, stores and spares, no. So for each class, if the discrepancy is a 10% or more, then only required to report the amount here. Next point regarding inventory is relating to working capital loans. So this point says that whether your client company has got any working capital loan, has been sanctioned working capital loan on the basis of their current assets from any bank or financial institution for an amount exceeding 5 crores. Whether your client company has got any working capital loan on the basis of security of current assets for an amount exceeding 5 crores at any point of time during the year. If yes, see, generally when your client has got the working capital loan against the security of current assets, then your client will be required to submit quarterly stock statements. Your client will be required to submit quarterly stock statements. So they will submit the quarterly stock statements. Accordingly, the limits will be reset. Now they have put one responsibility on the auditor to check your client, whatever quarterly stock statements your client is submitting to the bank, are they matching with the books of accounts or not? That means I have a responsibility to check whether my client is submitting genuine stock statements or fake stock statements that my client is submitting. That I need to check and give a comment. And this point will become applicable only when your client company has been sanctioned a working capital limit of more than 5 crores, sorry. So if you see here, whether at any point of time the company has been sanctioned working capital limits in excess of 5 crore rupees in aggregates from banks or financial institutions on the basis of security of current assets. If yes, they will submit quarterly returns. I need to check whether that returns are in agreement with the books of accounts or not. Clear? Next. So 2 points we have covered. Third clause is regarding investments, guarantee, security, loans or advances given by the company. So if your company has given any loans or advances and all, for that we need to report some points. Total under clause 3, we have 6 matters which are required to be reported. See, first point talks about segregation. So what does first point say here is, check whether your client company has given any loans and advances. If yes, we need to identify how much amount of loans are given to subsidiary, associate, joint venture, divided, others. So we need to check whether my client company has made any loans and advances. If yes, I need to identify how much amount of such loans are given to subsidiary, associate, joint venture, how much amount of such loans are given to others. Now, for subsidiary, associate, joint venture, I need to disclose how much amount of loan has been given, and also closing balance as on the balance sheet date. For others also, how much amount of loan has been given and what is the closing balance. Simply, I have to bifurcate. What is the amount of loan given and closing balance for subsidiary, associate, joint venture, and for others. Bifurcate the amount and report it. However, this point is not applicable in case if you are conducting audit of such an entity whose principal business is to give loans. This reporting requirement will not become applicable in case if you are conducting audit of such an entity whose principal business is to give loans. That means for NBFCs, this point will not become applicable. For banking, CARO is altogether exempted, but for NBFCs, this point is not required to be reported. So that's what you will be able to find it here. So when the company has given loans, provided advances to the guarantee, you need to simply bifurcate what is the aggregate amount and outstanding balance to subsidiary, associate, joint venture, and aggregate amount and balance outstanding to parties other than subsidiary, associate, and joint venture. Second one, this is something a repetition from 143 subsection 1. I need to check under whatever terms and conditions these loans, investments, or guarantees are made. Are they prejudicial? Are they not prejudicial to the company's interest? Nothing but terms and conditions should be fair. There should be proper rate of interest. There should be proper security. There should be a proper repayment period. So like that, whether terms and conditions are not prejudicial to the interest of the company, I need to check. Third one, the company just like that should not give the loans and ignore it. I need to check that whether they have prepared a schedule of repayment of principal and payment of interest. Repayment schedule should be there. And I should check whether the receipts are regular on or before the due dates they are receiving that installments or not. I need to check. Then if any amount remains overdue for more than 90 days, if any amount remains overdue for more than 90 days, I need to check what steps are taken by the company for recovery of that principal and interest. So I need to check if any amount remains overdue. If it remains overdue for more than 90 days, what steps are taken by the company for recovery of that principal and interest? I need to comment. Then this point, E point, talks about rescheduling extension of overdue loans. So what do you mean by this is, so what does fourth point say here is, the company has given loan in the past, which has fallen due in the current year. What do you mean by fallen due? Due date is in the current year. So if it has fallen due in the current year, what they should have done, they should have recovered it. They should have recovered it. But what the company is doing is, instead of recovering the money, they have either extended the loan, or either they have renewed the loan, or they have given fresh loan to the same person from which he is repaying the old loan. You tell me, should it be done or should it not be done? It should not be done, right? So that's what they are asking you to check, whether company has given loans or advances in the past which has fallen due in the current year, but instead of recovering it, the company is either extending it, renewing it, or fresh loan is given to the same party to settle the existing loan. If you find any such a transaction, disclose what is the total amount of such extended, renewed, or fresh loans given to the same parties, and also calculate the percentage with the total loans. From the total loans, how much is this percentage of loans? That percentage also you have to calculate and report it. However, here also this point will not become applicable in case of those entities whose principal business is to give loans. So that means for NBFCs, once again, this point will not become applicable. And then comes the last point regarding loans, demand loans without repayment period. So you need to check whether your client has given any loan without mentioning any repayment period. Is it a good sign or bad sign? It is a bad sign. So you need to check whether your client company has made any loan without mentioning any repayment period. If yes, then you need to disclose what is the aggregate amount of such a demand loans. You need to calculate percentage to the total loans, and even you have to specify how much amount of such loans are given to promoters and related parties. So this is the third clause. So totally under third clause, which is talking about loans, investments, and guarantees, 6 points we need to check under this clause number 3. Number 1, we need to segregate the balance, aggregate amount, and balance outstanding between subsidiary, associate, joint venture other than subsidiary, associate, joint venture. Number 2, terms and conditions I have to check. Number 3, I need to check whether there is a repayment schedule. Number 4, if something is overdue for more than 90 days, what steps are taken for recovery? Number 5, if any loan has been renewed, extended, or fresh loan given, what is the amount and percentage? Number 6, if any loan has been given without mentioning any repayment period, what is the total amount, percentage, whether how much amount has been given to promoters and related parties? But out of all this, first and fifth point will not become applicable for a company whose principal business is to give loans. Next, fourth one is also talking about investments and guarantees made by the company. Very simple here. I need to check in case if the company has made any investment or guarantee, whether they have complied with the provisions of section 185 and 186 of the Companies Act. That's it. If not, the details of the non-compliances. Then fifth clause is regarding deposits, whether your client company has accepted deposits. If yes, whether they have complied with the requirements of 73 to 76 of the Companies Act, whether they have complied with the directives of the RBI, whether they have complied with order of any company law board or court or tribunal. If there is any non-compliance, nature of the contravention should be stated. That non-compliance should be given. So fifth point is regarding deposits. Next, sixth point is regarding cost records. I need to check whether my client is required to maintain cost records as per section 148, whether section 148 will be applicable for my client. If yes, whether they have maintained that cost records or not, I have to give a comment. So total 6 clauses we are done. What are the first 6 clauses? First clause is regarding PP, second clause is regarding inventory, third clause is regarding loans, investments, guarantees made by the company. Fourth point is also regarding loans and investments and guarantees. Fifth point is regarding acceptance of deposits. Sixth point is regarding cost records. Seventh point, once again important point, statutory dues. There are some reporting requirements regarding statutory dues. Sir, what are statutory dues? Statutory dues are those dues which are required to be paid mandatorily under law. And for the purpose of reporting requirements, these statutory dues are divided into two categories. Number one is undisputed statutory dues and the other one is disputed statutory dues. Sir, what is undisputed statutory due? There is some statutory amount which you are required to pay and you are not going for appeal or no conflict is there, you also agree to it. So such an undisputed statutory due. Sir, what is disputed statutory due? There is some amount which you are required to pay as per law, but you are filing an appeal. A case is pending before assessing officer, court, tribunal, high court, supreme court, whatever it is. So when it is an undisputed statutory due, I need to comment whether the company is regular in depositing all its undisputed statutory due. On or before the due date, the company is making deposit of all that undisputed statutory dues or not. And number two, you need to check if there is any amount outstanding for a period of more than 6 months from the date it become payable as on the balance sheet date. If some statutory due is not paid and there is no dispute also, you are required to pay some statutory amount and there is no dispute also, but it is remaining unpaid and it is remaining unpaid for a period of more than 6 months as on the balance sheet date, that amount you are required to report. Which means, say for example, I am conducting audit of financial year 24-25. So the company is required to pay some TDS amount. Say they are required to pay some TDS on 31st of Jan 2025. But this amount is not paid till 31st of March 2025. Undisputed. No dispute is there. 10 lakh rupees of TDS they have not paid. Am I required to report? No, not required to report. Sir, it is outstanding. No, yes, it is outstanding. But you are required to report only when it remains outstanding for a period of more than 6 months. So it is outstanding only for a period of 2 months, not required to be reported. So only those statutory undisputed dues which are outstanding for a period of more than 6 months as on the balance sheet date, only those are required to be reported. Clear? So when it comes to disputed statutory dues, two things you are required to report: what is the amount involved in the dispute and forum where the dispute is pending. Basically, before which authority the case is pending, that is required to be disclosed. Next, eighth clause, which is talking about disclosure of undisclosed income. Sir, what do you mean by disclosure of undisclosed income? Very simple. What here they say here is, during the current year, if any income tax assessment has taken place, either scrutiny, raid, whatever it is, if any income tax assessment has taken place, and as a part of that assessment, some income has been surrendered or disclosed. Some income which was not previously disclosed in the books of accounts, which was not previously recorded in the books of accounts, that was surrendered or disclosed as a part of income tax assessment. That means as a part of assessment, you have offered it. Now, just offering to the tax authorities alone will not be enough. That would have not been recorded in the books of accounts also in the past. That previously unrecorded income should have been brought into the books of accounts also. So basically, for the purpose of clause 8, we need to check whether during the year any income tax assessment happened. As a part of that income tax assessment, whether any undisclosed income has been surrendered. If yes, just surrendering to the tax authorities alone will not be enough. Even that unrecorded income should be brought into the books of accounts. Whether they have done it or not, I have to check it. Next. So now ninth point is regarding loans. So till now we have seen so many clauses talking about loans given by the company. Now we have clause 9, which is talking about loans accepted by the company. If your company has taken any borrowings, regarding that repayment of the loans, I need to check certain points and you have to include in the CARO report. What are they? Number 1, I need to check whether company has made any default in the repayment, either payment of principal or payment of interest, whether company has made a default. What do you mean by default? Not pay. Even if you don't pay in time, that is also default. Say for example, due date is 8th of August, but you paid it on 9th of August. Has the company made default? Yes. So either not paying altogether or even paying after the due date is also default. So I need to check whether the company has defaulted in repayment of loans. If yes, I need to report the period and the amount of default. That too lender wise I have to report. For each lender, what is the amount of the default? what is the period of the default? That lender wise details you are required to report it. Next one, willful defaulter. I need to check whether my client has been declared as willful defaulter by any bank or financial institution. So you need to get the credit scores or CIBIL reports. From there you can find it out. Third one, if your client has taken any term loan, they would have stated the purpose. They are going to use this term loan for some purpose. I need to check whether my client has used the term loan only for the set purposes. If not, if the loan is diverted, the purpose and the amount which has been diverted, that I am required to report. Fourth one, if your client has taken any short-term loan, but instead of using it for short-term purposes, have they used it for long-term purposes? That I need to check and give a comment. Fifth one, your client has taken a loan not for your client's requirements, but your client has taken a loan to meet the requirements of subsidiary associates and joint ventures. If yes, what is the amount of such loans? You have to report it. So if you see here, whether company has taken any funds from any entity to meet the obligations of its subsidiary associates or joint ventures, if yes, nature of such a transactions and amounts also you are required to report. Last one, your client has taken a loan by pledging the securities which it holds in subsidiary associate and joint venture. Fifth point says your client has got the loan to meet the requirements of subsidiary associate joint venture. Report it. Sixth point, your client has got the loan for your client's requirements only. But for getting that loan, you need to pledge something. No. What they have pledged is they pledged the securities of subsidiary associate or joint venture. So pledging the securities of subsidiary associate joint venture, if your client has got any loan, you need to give the details thereof and also report whether the company has defaulted in any of such loans. Clear? So when it comes to the ninth point, repayment of loans, we have in total some 6 points which are required to be reported. What are they? Number one, client has made any default in the repayment, whether your client is declared as willful defaulter, whether the term loans were used for the set purposes, short-term loans were used for long-term purposes, whether your client has taken any loan for meeting the obligations of subsidiary associate joint venture, and whether your client has taken any loan by pledging the securities of subsidiary associate joint venture. Next one. 10th point talks about IPO or FPO, whether your client has made any IPO or FPO. If the client is going for IPO or FPO, they will release a prospectus. In that prospectus, they will say for what purposes they are going to make use of it. So I need to check whatever money, whether money raised by way of IPO or FPO, including debt instruments, including debentures IPO, whether they are utilized for the said purposes, for whatever purpose which has been mentioned in the prospectus, for the same purpose the money raised has been used or not. I have to check it. If not, if you find that the amount has not been used for the set purposes, defaults, delays along with subsequent rectifications, everything should be reported. Same thing for preferential allotment. If your company has made any preferential allotment or private placement of shares, here I need to check whether section 42 and 62 of the act has been complied with or not. Even for preferential allotment or private placement also, there will be prospectus, they will mention the purpose. There also I need to check whether they have been used for the said purposes or not. If not, provide the details in respect of amount involved and what non-compliances they have done. So this is what regarding clause 10. So till now we have completed 10 clauses. What are they? Number 1, PPE. Number 2, inventory. 3 and 4 regarding loans. 5 is regarding acceptance of deposits. 6 is regarding maintenance of cost records. 7th is regarding statutory dues. 8th is regarding unrecorded income. 9th is regarding repayment of the loans. 10th is regarding utilization of IPO or FPO. Now coming to the 11th point regarding frauds. If you have any fraud that you are required to report it under 143 subsection 12, in addition to that, you are also required to report the fraud under CARO also. So whether any fraud by the company or on the company has been noticed or reported during the year. If yes, what is the nature of the fraud, amount involved in the fraud, mentioned in the report of, mentioned in the CARO also. See, there is slight difference here. Under 143 subsection 12, if you have reason to believe, you have to report. But under CARO, you have to report only noticed or reported frauds. That means proven frauds are only required to be reported, whereas under 143 subsection 12, reason to believe is enough. Next one, you need to comment whether any of the auditors have submitted form ADT 4, whether any of the auditors have submitted 143 subsection 12. Form ADT 4 just now I have told you, right? So I need to comment whether any of the auditors, not just you, either secretarial auditor, cost auditor, whether any auditor has submitted form number ADT 4, that I have to give a comment. And whether auditor has considered whistleblower complaints. If there are any whistleblower complaints, whether you have considered it or not, you have to comment. 3 points are required to be commented under clause 11. Then we have Nidhi company. In case if you are conducting audit of a Nidhi company, 3 things we need to check. Nidhi company should have net owned funds to deposits ratio of 1:20. That means for every 1 rupee of net owned funds, they can accept a maximum 20 rupees of deposits. Whether they complied with that or not, we have to check. And also whether Nidhi company has kept a 10% in unencumbered term deposits, yes or no, that you have to check. And also I need to check whether Nidhi company has made any default in the payment of interest or repayment of principal. So 3 points: net owned funds to deposits ratio, 10% should be kept in unencumbered term deposits, and whether they have made any default in the payment of interest or principal. Next, I need to check whether any related party transactions are there. If yes, whether they have complied with section 177 and 188 wherever applicable. And also there are various disclosure requirements for related party transaction as per accounting standards. Whether all that disclosure requirements are fulfilled or not, I need to check. Then I need to check whether my client is having internal audit system which is matching with the size and nature of the business. And also I need to comment, as a statutory auditor, did I make use of any of the report of the internal auditors? Have you considered any report of the internal auditors? That also I need to check. So clause 13 talks about related party transactions. Clause 14 talks about internal audit system. So internal audit system is very, very easy. In internal audit system, only 2 points: whether your client is having internal audit system commensurate with size and nature of the business, and number 2, reports of internal auditor, have you considered it or not. Then 15th point, non-cash transaction. I need to check whether company has entered into any non-cash transaction with the directors of the company. If yes, there are certain rules under section 192 of the Companies Act, whether they have been complied with or not, I need to check. Then in case if you are conducting audit of NBFC, then there are certain points you are required to report. Number 1, is the NBFC required to get the registration under 45 IA of the Reserve Bank of India Act? If yes, whether that registration has been obtained or not. Number 2, whether your client is carrying out any non-banking financial or housing finance activities without obtaining certificate of registration. Number 3, whether your client company is a core investment company. If yes, whether they fulfill the criteria of CIC. In the CIC also, if you fulfill extra conditions, you will become exempted or unregistered CIC. Whether that additional conditions are fulfilled or not, I need to check. Which means if your client is NBFC, say for example, just example sake I am saying, if your client is a NBFC, if they fulfill some 10 conditions, they get the status of CAC. If my client is a CAC, whether that 10 conditions are fulfilled or not, I need to check. After becoming CAC, if I fulfill some extra 5 conditions, then I will become exempted or unregistered CAC. If my client is that exempted or unregistered CAC, I need to check the compliance with these 5 additional conditions also. Basically, criteria they are meeting or not, I need to check. Then also I need to comment, if my client is a big group companies, my client is having various holding subsidiary associate companies, as a part of entire group, is there only one CIC or more than one CIC? If there is more than one CIC in the entire group, I need to mention what is the total number of CICs as a part of that group. Clear everyone? So this is what regarding NBFC. 3 points. Number 1, whether they obtain registration under RBI. Are they conducting any non-banking financial or housing finance activities without obtaining certificate of registration? Number 3, is your client is classified as CIC or exempted CIC, whether they fulfill the criteria. As a part of the group, is there one CIC or more than one CIC? If there is more than one CIC, what is the total number of CICs as a part of the group? Next one. 17th point, has your company made any cash losses, that too in the current year as well as the preceding financial year? If yes, that amount of cash losses you are required to report. So one thing you have to remember here, you need to report the amount of cash loss only if the company has made cash loss in the previous year also, in the current year also. If the company has made cash loss only in 1 year, no need to report. In the previous year, in the current year, in both the years they should have made the cash losses, then only you are required to report it. Next, see, cash loss is different, loss as per the statement of P&L is different. Sometimes as per the statement of P&L you might find a loss, but that might not be cash loss. So from the P&L you need to do the reverse calculation and calculate the cash losses. Say for example, the company might be having a loss as per the statement of P&L, 2 crores of loss is there, but this is not a cash loss. Now I need to calculate the cash loss from this. So loss as per the statement of P&L is 2 crore, but the depreciation, non-cash expense is there, 5 crore, I have to add it. If you add it, the company has actually made a cash profit. So if you have a loss as per the statement of P&L, that is not when reporting requirements will come. The reporting requirements under CARO clause number 17 will come only when you have made a cash loss, that too in the current year and also in the previous year. So you need to calculate the cash loss. Next, resignation of the auditor. You need to check whether any of the statutory auditors have resigned. If yes, try to understand because of what issues, because of what objections, because of what concerns they have resigned and how they are having an impact on your audit, that you need to check. So whether any of the previous auditors resigned, if yes, you need to understand because of what issues, what objections and what concerns raised by the previous auditor. Next one, this is one such point. 19th point is one such point where you need to comment on the future. Generally in audit, we comment only on the past, but this is one such point where they have extended our scope to the future. So now what this point number 19 says is, the auditor has to, I will read this in a different order. So if you read the second point here, you need to comment whether auditor is of the opinion that there is no material uncertainty existing as on the date of the auditor's report, that the company is capable of meeting its liabilities existing at the balance sheet date as and when they fall due within 1 year from the balance sheet date. Which means what? Say for example, 24-25 financial year. The financial year starts from 1st of April till 31st of March 2025. Now after the year got closed, I am doing the audit. Say for example, I am giving my audit report on 30th of June. Now I need to analyze as of this date, as on the date of auditor's report, is the company having the capacity to pay all the liabilities which fall due within 1 year from the date of balance sheet. From the date of balance sheet, if you calculate 31st of March of 2026. So whatever liabilities which fall due within 1 year, basically current liabilities. So whatever liabilities which fall due within 1 year from the balance sheet date, is the company in a position to pay that liabilities, or is there any uncertainty existing? That you have to determine as on the date of your auditor's report, and you have to say your opinion. So if you see here, once again, if you read it, whether auditor is of the opinion that no material uncertainty exists. That means the company is capable of paying as on the date of auditor's report, that company is capable of meeting its liabilities existing at the date of the balance sheet as and when they fall due within 1 year. So whatever liabilities which are existing on the balance sheet date and which fall due within 1 year, that is basically all your current liabilities, is the company having capability to pay its current liabilities, or is there any uncertainty that you have to give your comment? But however, on what basis you give your comment? On what basis you will give your comment? Just whatever comes to your mind you will say? No. On what basis you have to give your opinion is, on that they say it in the first point, on the basis of financial ratios. You have to calculate some ratios. You have to do some aging analysis of expected dates of realization of financial assets and payment of financial liabilities. Nothing but what is the date of realization of your debtors, what is the date of payment to the creditors, are you receiving the money before the payment dates, and using other information accompanying financial statements, and also auditor's knowledge of board of directors and management plans. Even as an auditor, you have to go and sit with the management, try to understand their plans, and after considering all this information, you have to give your opinion. Clear everyone? So simply I have to express my opinion, is the company capable of paying its current liabilities? On what basis I will say this information? On the basis of financial ratios, aging analysis, and on the basis of realization of financial assets and liabilities, using information accompanying financial statements, and even auditor's knowledge of board of directors and management plans. Using all this information, I have to comment. Then regarding CSR expenditure, I have some reporting requirements. Very simple, they try to say here. I will try to explain it. Clause number 20 regarding CSR expenditure, 2 points I need to report. Number 1, say for example 24-25 financial year, the company is getting covered under section 135. They need to spend 2% of their average profits on CSR. Say for example, average profits of the company is 100 crores, 2 crore rupees they are required to spend on CSR. Now what the company has done is, within 6 months, that means till 30th of September, they want to develop a project. They have to decide a project, how they are going to spend the money. So they are required to spend 2 crores of money, right? The company has decided 1 crore they will use it for construction of school. In the rural area, they will construct one school. Some 50 lakh rupees they will give it as donation to the old age home. Some 30 lakh rupees they will give it as donation to orphanage. So they are required to spend 2 crore rupees till 30th of September. They have projects for this much amount. 1 crore they want to spend it on school. 50 lakh rupees they want to give it as a donation. 30 lakh rupees they want to give it as donation to orphanage. I'm not telling they have spent it. They have a project ready. For how much amounts they have a project? For 1.8 crore they have a project. For how much amount they have to spend? 2 crore. That means within 6 months from the end of the balance sheet date, they are unable to have the projects for 20 lakh rupees. They are not able to decide how to spend that 20 lakh rupees. I'm not telling money should have been spent. Having a project itself is alone enough. So out of 2 crore, the company is having a project for 1 crore, 50 lakh rupees and 30 lakh rupees within 6 months. But within 6 months, they are unable to decide, they are unable to have any project how they are going to spend this 20 lakh rupees of money. So now what the Companies Act has told us, this amount they have to transfer it to a fund specified under Schedule 7. In the Schedule 7, they have specified some funds like PM CARES fund. So PM National Relief Fund, like that they have specified some funds. This money should go to that fund. Once the money go to the fund, government will take care of it. Now I need to check whether this amount for which there is no project that has been transferred to the fund specified under Schedule 7 or not. That I need to check. So whether in respect of other than ongoing project, that means you don't have any project ready, the company has transferred unspent amount to a fund which is specified under Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. Next, second point, one more point we have. See, within 6 months they have a project ready. Say for example 50 lakh rupees, they want to give donation. They have written a check and gave the donation. 30 lakh rupees, they want to give it as a donation to orphanage. They have written the check and gave it to the orphanage. 1 crore, they want to construct a school. But as we all are aware, school construction will not take a day or two. So they have a project ready for 1 crore, but they did not spend the money yet. So now what the act says is, if you have a project ready, but the money is not spent for the project, that money is going to take some time to be spent. This money should be kept in a separate bank account. This money should be kept in a separate bank account. Company only will have control over it. Just to segregate the normal funds from the CSR funds, they are asking you to keep that money in a separate bank account. So whether the company has kept that in the separate bank account or not, that also I need to check. First case, if you don't have project ready, the money will go to the government. It will go to fund. Second case, you have a project ready, but you want to spend it slowly, keep that money in the separate bank account. So that's what they say here. Whether any amount remaining unspent under 135 subsection 5 pursuant to any ongoing project. That means you have a project ready, but the money is not yet spent. That amount has to be transferred to a special account in compliance with 135 subsection 6 bank account they are talking here. So these are the reporting requirements under clause 20. So these 20 clauses will come in the audit reports of the standalone financial statements. Now clause number 21, this will come only in the audit report of consolidated financial statements. Now what is this clause number 21 says is, clause number 21 says, see, you are conducting audit of consolidated financial statements. What will be included in the consolidated financial statements? Holding companies will be there, subsidiary companies will be there, associates will be there, joint ventures will be there. Now what they say here is, if you are conducting audit of consolidated financial statements, you should go through audit reports of all the companies which are included in the consolidated financial statements. And in the audit reports of each of these companies also go to CARO section and find out in any of the 20 clauses, does any clause contain a negative remark? So if you are an auditor conducting audit of consolidated financial statements, get the audit reports of all the companies which are included in the consolidated financial statements, go through their CARO reports, find out in any of that audit report, any of the paragraph of the CARO contains a negative remark. If yes, mention that in the consolidated financial statements audit report. So you have to say for example, in the holding company, para number 11 contains a negative remark. So I have to say in my consolidated financial statements audit report, so and so company X Limited, which is a holding company, in their CARO audit report, para number 11 is there, which contains a negative remark. That name of the company, relationship, and which paragraph contains a negative remark, that information you have to include. This only one point you have to include in the audit report of the consolidated financial statements. So if you see here, whether there have been any qualification or adverse remarks by the respective auditors in the CARO reports of the companies which are included in the consolidated financial statements. If yes, indicate the details of the companies, paragraph numbers of the CARO report containing the qualification or the adverse remark. Understood? So this is one such clause which will come in the consolidated financial statements, and these 21 matters under CARO, you have to report it whether you have a positive comment or negative comment. In all the cases you are required to report it. And in case if you are giving any negative remark, you have to mention the reasons why you are giving negative remark. In case if you are unable to express opinion on any of the clauses, you have to explain the reason why you are unable to express the opinion. Understood? So this is what the revision of the audit reporting chapter, where we have revised 4 standards along with various reporting requirements under section 143, various subsections of section 143. Hope you guys might have found this marathon series informatory and value addition in your preparation. So we'll see you in the next day. Tomorrow once again we'll start the live marathon from morning 9 a.m. So we'll discuss the subsequent chapters as a part of our subsequent sessions. Okay, so everybody